inflation keeps rising, keeps surprising.
The Fed's going to lose its case to keep raising rates, maybe sooner than we think.
We're still leaning towards 75 just because I'm not sure Powell wants to do shock and awe.
I think the bigger issue maybe for the Fed, and they won't talk publicly about it, but it's the strength of the dollar.
If you start to push back against a strong dollar, you're effectively saying the Fed should be hiking rates as aggressively. That is a problem in itself.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a messy market. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures lower, yields higher. TK, that dollar a whole lot stronger.
You need to put it in scale right away. It's correlated move. The dollar's there. Jane Foley to come up will be authoritative on this. What's important, John, 200 business days of the year. This is one of the 5 most correlated grim days. Guess what? I heard it from FedEx.
Yields up at the front end for 7 straight days. To TK's point, companies starting to come out and warn about the environment too.
They're worried about the slowdown that they're seeing in activity and the slowdown in business confidence. But just to put that scope, that scale and scope for the 2-year yield, it's risen
Stunning.
1 full percentage point
390
since the end of July. That is basically increasing by 1/3 for this benchmark
And
rate.
now we're talking about 4% potentially. Deutsche Bank and Matt Lazzetti, thank you, Matt, for reaching out yesterday. Rates at 5%, close to next year. That's their call now.
4.9% is the terminal
Wow.
rate, but the market is not that far away. Right now, the market's pricing in 4.5% by March next year.
Fed funds up, Tom. Mortgage costs, you've seen that? 6%.
Yeah.
6% on average on a 30-year mortgage.
Let's talk about
now.
the real ramifications here, not the fancy financial stuff we'll talk about all through the day. 6.2% on a mortgage. I did some of the math off bankrate.com, and here's the math. You need a much higher income to make your housing dream happen, and you're not going to get it, so you're going to rent. What's that going to do to rents nationwide?
What's it going to do to growth, Bramo? What is it going to do to rents? You've brought that up. If you can't afford to buy, what do you do? And what's going to happen to shelter costs over the next several quarters?
Well,
Move to London. Is that a solution?
That's the reason why he's particularly
I think we
aware
need to
of
have a little look at sterling to explain why TK is thinking about a move
we'll
to London.
There. And actually, that's actually an incredibly important story. But to that rent picture, it will increase rents in the short term. This has been the issue because people can't afford to buy, so it increases demand on the rental side.
And pause, a moment of silence for pound sterling. TK, 113. 113.
Let's pause here. We make jokes about it, folks, but John Ferro did a 28-hour day the day of Brexit. This is not where sterling was when you were announcing Brexit.
And you were somewhere else having a drink and a long
real estate agent.
I'm aware. We've talked about that a few times.
Knightsbridge.
This took out the lows of Brexit. This took out the lows of the pandemic. We did that in the last week or so. We took out the lows of the last week or so. Now we're talking about 113. And all of a sudden, once again, looking ahead to the Bank of England next week, we've had 75 from the Fed, set to do it again next week, 75 from the ECB. Do we get 75 from Governor Bailey and this central bank around the corner?
And will that help? Right? I mean, will that really support sterling that's responding to an economic backdrop that's really questionable? And I have to just note that this break beneath 114 is coming on Black Wednesday, 1992. The anniversary of that is today, and that really highlights where we are full circle.
We're going to sit on that story. Do you not remember that, Tom? 1992?
That's when the Bank of England abandoned the effort to
referred to as Black Wednesday,
TK.
What do you refer to it as? Soros and Druckenmiller Day?
Yeah, this Stan Druckenmiller did a great job on that. And we got to get to our esteemed guest, John, but where do you start the data check? Where do you start?
I'm going to start with yields, up at the long end and at the front end as well. 2-year yields higher for a 7th straight session. We went through 360. Through 370, 380, 390, a 10-year that's threatening to take out the highs of the year, 347 on a 10-year, up a couple of basis points. Yields up, dollar stronger, euro dollar negative by 1/3 of 1%, 99.70, and futures, Bramo, futures down 1% on ES&P.
Yeah, and there's a real reason why. I mean, if you take a look at real rates, also real yields, and I know that Tom has been really on this, it's climbing to the highest since 2018. There is not a big argument for why there should be a great deal of optimism right at this moment with peak hawkishness, if we are at peak hawkishness. All right, today is day 2 of China's Xi Jinping and Russia's Vladimir Putin meeting. What did you call it, John?
Peak Bramo.
A meeting of dictators?
The convention of the dictators, and Tom said that was too mean. I thought it was accurate.
All right, well, yesterday, Vladimir Putin said that he understands Beijing's questions and concerns about the Ukraine invasion, which was actually pretty interesting, considering that they hadn't really shown public disagreement. It's clear that China has had some problems with Russia's approach. And so this really raises some questions, and I'm watching this particularly closely. 8:15 a.m., this is going to be a great interview. Colombia's finance minister, Jose Antonio Ocampo, is going to be joining us here on television and on radio. How do they deal with a dollar that's this strong? And the World Bank raised this alarm. This is one of the biggest issues. What does this do to the rest of the world? This is a huge concern, and I want to hear how different central banks around the world are thinking about this. And at 10 a.m., we get University of Michigan Sentiment Survey for the month of September. Remember when it used to be University of Michigan Sentiment Survey Friday?
And we ignored it.
Well, I mean, we're ignoring it now, right? It's not necessarily going to be that significant, but we're expecting it to increase. Sentiment's getting better. Is that a good thing?
I don't think it changes anything for the Fed next week, does it?
Well, but if their sentiment improves, doesn't this actually just give the Fed more confidence to go in harder?
Was that a story yesterday with claims? Claims at, what was it, 213?
Yeah, just
wow.
Dramatically lower than people had expected. The labor market
better as well.
Yeah.
Implied by lower. Anyway, Jane Foley, head of FX strategy at Rabobank. Long week for all of us. Will we get on for the next 2 hours? We will get on along with Jane Foley, I can guarantee you that. Head of FX strategy at Rabobank. Jane, the significance of a 113 on sterling. Can we start there?
Well, it's very significant, as Lisa talked about, 1992 and sterling being forced out of the ERM. And, you know, when thinking about that story this morning, the first thing that came to my mind was the current account position of the UK, because if you've got a current account deficit, and don't forget, the UK deficit as a percentage of GDP is right now at record levels. It's much worse than it was in 1992. But if you have a deficit, really you're exposing your country to more of the whims of non-domestic investors. And if they do not like the fundamentals that they see, your currency is going to adjust lower. Now, right now, I think that's something which has been happening to the pound, you know, for a while. The market doesn't like the growth story, it doesn't like the Brexit story, right. and it doesn't like the fact that the tax cuts that are coming from the new Prime Minister could really push the public finances into numbers that people just don't like. So sterling is vulnerable, and that current account position really exposes the UK. Now, of course, a lot of the story is dollar strength, but there is certainly sterling weakness in here. And one thing that we did see earlier in the year is interest rate hikes couldn't pull the pound out of the hole.
To Lisa's point.
To Lisa's point. Will a 75 basis points move offer that much protection? Well, some maybe, but not all.
Chris Giles, the FT, with a brilliant short essay pulling the United Kingdom back to, I believe, 1972-74, and Mr. Barber, the complete failed plan then is this Chancellor of the Exchequer going down in flames with a growth model that's undoable?
Well, certainly the market is extremely sceptical. I mean, he's been talking about a growth target for the UK at 2.5%. Nobody really expects that can happen. So you're talking about tax cuts, which will give a bit of a boost. But actually, what investors want to see are measures that are going to improve, you know, productivity and growth and potential output, not just a quick fix from tax cuts. So investors are sceptical, and that is what the government is facing, and that is what the government today appears to be ignoring.
It's a sterling story. It's a Chinese yuan story. There are specific stories about weakness, but on the other side, it's very much a dollar story, especially as we're pricing in such high potential Fed funds rates next year. What is your sense of when things break, of when the stronger dollar creates weakness that becomes hard for all of these other central banks and these economies to get out from under?
I think you could probably already argue that the strength of the dollar is already pushing half of the economy, half of the world economy under the bus. You know, it is very, very difficult, and I think we see this already for a long time in emerging markets. So many interest rate hikes there to try and protect their currencies. Look at just Korea
are we at the
this
plaza
week.
Level?
Well, you see, I don't think that's particularly logical, because if you have a central bank putting up interest rates, you know, you've got to say, well, a strong dollar is a byproduct of that policy. So why then come in on the other hand and say, well, we're going to weaken this currency? It's not logical. So maybe we were talking about some sort of plaza thing maybe next year when the Fed is confident that it has got inflation under control. But
is
right
there
now
a negative feedback loop that you can think of from the rest of the world into the US economy that the Fed has to respond to?
Well, I mean, I don't know whether the Fed has to respond to it, because after all, the Fed's primary objectives is domestic inflation and domestic employment. Should it address it? You know, I don't know. You know, that's another question. But certainly there is a feedback loop into the US dollar, because as the rest of the world weakens, as emerging markets weaken, people tend to buy the dollar.
Yeah.
And so if you're buying the dollar because the strong dollar is worsening the environment for the rest of the world, you've got this feedback.
More buy-in.
Absolutely. So, you know, what is going to break it? I think it's only going to break maybe, you know, next year when the Fed thinks, you know what, we can calm down on this. We've got a handle on medium-term inflation expectations.
Until then, let's talk about some levels and squeeze this in. Cable, sterling against the US dollar, 113. Euro dollar in and around parity. Dollar China through 7. Are you thinking of some big moves from here, or is this kind of it?
I don't think it's it yet. We're thinking 95 on euro dollar. I mean, we've got a horrible winter to come for Europe. Yeah, you know, energy price crisis, you know, rationing. Is that all priced in up? I think perhaps not. Have we got an Italian election? You know, will the far right get in? You know, that's perhaps, you know, the next potential trigger for the euro in just a few weeks' time. On Kate, well, our target now is 109. People are out there talking about parity. Can we dismiss that? You know, no, I don't think we can dismiss it. It's not our target, but, you know, it depends very much on the US dollar. So, you know, these are still nasty numbers to come. And right now, you know, I think the dollar strength will sustain until you can honestly answer the question, well, what else are you going to buy?
For the best part of 10 years, I think it's fair to say foreign exchange was kind of boring, and it's not boring anymore.
No.
Not at all.
No.
Jane, great to catch up. Jane Foley there of Rabobank. What a moment, hey guys, to have a serious conversation about parity on cable. Not to say it's going to get there, but the fact that's part of the conversation in a way that I don't think it's ever been a part of the conversation. Euro dollar at 95, and people hear that and they're like, yeah, sure. I'm used to those kind of numbers now.
It's 90 of Jordan Rochester that gets people's attention, Tom.
And as Jane Foley said, this goes back to Major in 1992, which is a chart I look at all the time. The timeline here back to where we are, Lisa mentioned 2s, 30s, back to 2000.
The 2's looking at 4%. I think what we're witnessing now, and Joe Weisenthal, I think it was, out on Twitter, who said this, just the end of the zero interest rate policy world getting absolutely obliterated in the last 12 months.
And it's really messy, and it probably is going to get messier, and that's really the feeling.
Andrew Sheets on that of Morgan Stanley, who'll join us in the next hour, live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The economy in China showed signs of recovery last month. Industrial production, retail sales, and fixed asset investment all grew faster than expected. Meanwhile, the urban jobless rate fell. Beijing had rolled out stimulus measures to counter a slowdown. Still, a property market slump and COVID lockdowns are weighing on the outlook. In Germany, the government has begun what may be a series of historic takeovers to try to avert a collapse of the energy industry. Regulators are taking control of Russian oil major Rosneft's German oil refineries. Germany is also nearing a decision to take over Uniper and 2 other large gas importers. More than 100,000 workers will decide whether there's a new labor agreement with U.S. railroads or a strike. They will vote on the tentative deal reached on Thursday. The agreement increases wages and includes a compromise on sick days. A timetable for the voting hasn't been released. It's a potentially worrying sign for the global economy. FedEx has withdrawn its earnings forecast due to worsening business conditions. The package delivery giant pointed to weakness in Asia and challenges in Europe. FedEx is taking immediate steps to cut costs, including parking some aircrafts, cutting workers' hours, and closing more than 90 FedEx office locations. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today is a win, and I mean it sincerely, a win for America. Together we reached an agreement, you reached an agreement that will keep our critical rail system working and avoid disruptions of our economy.
The President of the United States, live from London. This is Bloomberg Surveillance, and here's your price action. It's messy out there. Futures down 1% on the S&P 500, down on the week, down on the day. In the bond market, yields up another 2 basis points on a 10-year, 346.69. This dollar a lot stronger off the back of yields which are much higher. Euro dollar 99.70, negative a third of 1%. Pound sterling, a 113 handle. If you've been away from the market for a month, welcome back. A 113 handle. This came from Michael Hartnett over at Bank of America. I think he wrote this just for Lisa. This is what he said. Yes, it's fashion week for nouveau Uber bears, but inflation shock ain't over. What do you make of that?
Well, look, I do think that there is this feeling that right now everybody is waking up to the possibility of much faster rate hikes. And that has been the theme of this entire week. And really the question, and we keep repeating this, I sound like I'm just a repeat here, a broken record, but this idea of, yes, Tom, actually, no, I'll leave it there.
It's fire and rain.
So it's wind and fire.
Wind and fire.
But the question is, I'm just going to keep going, whether we have fully priced in the weakness in earnings, what we saw from FedEx, that comes along with higher rates and a Fed dead set on crimping some of the momentum.
I'm going to push back and go to the stock market, which Emily Wilkins cares about. And John, this is about a growth scare coming off the FedEx announcement, particularly for our international audience, including in London here. FedEx is a foundational company on the spirit of America. It's almost, John, a nominal GDP proxy. And that announcement is what tilted this market to further Bremo-like action.
Which I know, Tom, you follow super closely. And something we've all watched this year is rates snap higher and equities snap lower. And Mike Wilson of Morgan Stanley, his world now, TK. Mike Wilson of Morgan Stanley's been saying for a while.
It's a very Wilson
We
day.
move from the rate shock, you move towards the earnings shock. And Tom, people will be asking whether this headline is the beginning of that story.
Thank you, Quantas, for putting that up. FedEx down 20%. What else do you
brutal in
need
the
to know?
pre-market. Absolutely terrible, Tom.
Yeah, let's do this. Let's bring in Emily Wilkins, Bloomberg Government. We're going to rip up the script here as we can. Emily, every president, and particularly Republican presidents, understand the stock market, the market in general, is a huge political item. Do Democrats and does this president care about the stock market?
Biden does care about the stock market. I think when you say the stock market, that can go to a lot of different things, right? What presidents care about or what Americans care about. What Americans care about is exactly how much money they're spending. Are they spending more money than they're taking in? Are their raises matching up with inflation? Right now, that's really not the case. Democrats know it. Democrats know it's a problem. The CPI numbers this week were not good for them. They've been trying to avoid it by talking about the low unemployment numbers. They've been trying to avoid it by talking about low gas prices. But the fact of the matter is, any hope that they had last month that we were going to see inflation come on down before the November midterms really seems to be slipping away at this point.
Emily, into this difficult weekend, and certainly in London, we see a Bank of England independence tested by a new government, the Truss government. Revisit the independence that Jerome Powell has right now. What is the strength of the Powell independence?
I mean, at this point, President Biden has been very, very conscientious to try to make sure that agencies that have traditionally operated in an independent manner do so. If you remember, his predecessor liked to get a little bit more involved in those regards. But Biden's really tried to say, hands off here. We trust in Jay Powell. We're going to let him do his thing. Remember, he did get reelected to the position with bipartisan support from senators. And so he is in a bit of a strong place right now as far as operating, as far as what he is able to do. Certainly there's a sense, at least with Congress and the White House, is that there's really only so much they can do to bring prices down and make major shifts in the market. They can pass bills that have names like the Inflation Reduction Act, but in reality, a lot of this is out of Democrats' hands right now. And so they are relying on the Fed. They are hoping that they are going to be able to provide that soft landing that's been talked about.
Emily, this White House has a very difficult message to sell at a time, especially after yesterday, where they were celebrating unions and they were celebrating collective labor agreements and the idea of getting higher wages. And then on the flip side, this concern about how high inflation is. And to Tom's point, questioning whether the Fed has to curtail that and what their role really is in this. How is it being borne out in public sentiment when it comes to the whole union negotiations and the push for organized labor?
Well, certainly there's been a big shift in how labor is being viewed. You have a worker shortage right now. The advantage is a lot of the times with the workers and with unions. You've seen that in Starbucks. You are seeing it in rail. And I think we need to make sure that we're putting a little bit of asterisk on the whole rail debate. Yes, union leaders and industry leaders did come to an agreement after a 20-hour marathon session, but we're not done yet. The workers have to approve it. We've got 12 different unions. We've got 125,000 workers. And not all of them are going to be happy with this agreement. We already know that it doesn't have any sick days, even though it does have some more flexibility for a leave of absence if someone needs medical care. But this isn't exactly everything that they wanted. And I think there is still a question mark as to whether or not we're going to be facing a similar problem in a couple weeks from now if a lot of these rail workers do not agree to this, to what was hashed out by union and industry leaders.
Emily Wilkins, thank you. Down in Washington, D.C., the world's attention for financial markets will turn to Washington, D.C. and the Federal Reserve in about a week from now. We're going to catch up with this man right here. I have to say I'm really excited about doing this.
Yes.
We'll get the Fed decision, and then straight afterwards, you'll hear from former Vice Chair, Richard Clarida on Bloomberg Surveillance on TV and radio. After the decision, and Tom, we go one better. If you can go one better, he's going to join us after the news conference.
Yeah, it's very generous.
Very
this
cool.
time.
This
is very important. This is the former dean of Columbia Economics. He is a first-rate monetary pro with tangible published research. He and a guy named Gertler own the high ground, John, on the mathiness of a thing called DSGE. He's an authority on what they got wrong and what they need to do to fix it.
And Tom, the beauty of the last 12 months of Bramo, we've shared this opinion, I know, is that when you're a former Fed official, you seem to speak your mind just a little bit more than the current Fed officials.
Will he go full Bill Dudley, right? That's the question.
I don't know about that.
Are we going to start to see, 5% interest rates and that they're far behind and they're living in fantasy land? Are we going to get that kind of conversation from him? Or will we get a more deliberate, nuanced, Fed-like talk about restraint?
Are you worried that we might go in that direction?
I'm just telling you.
I would say off of his academics, what you're going to hear is they have only one path, and that is data dependency. They have to wait. And they're getting it this morning.
And Matt Lazzetti on that data dependence, Tom, over at Deutsche Bank. And by the way, Matt's going to open the show with us next week. We'll keep returning to his call.
Yeah.
4.9% on Fed funds next year for them.
That's
the
base
peak.
case. Yeah, exactly.
And as you pointed out, this market's not too far away.
That's the shocking thing. How much have we repriced the rate risk? What are you doing, Tom?
And that's sending stocks lower.
Richard from Pimco said play a song.
Down 0.9% Is that rich or is that wind and fire?
It's wind and fire.
Live from London, this is Bloomberg Surveillance, and here's the price action. Lower on the equity market, down 0.9%. Yields higher on a 10-year by 2 basis points, 346.89, and a 2-year up again for a 7th straight session. That's the 2-year. 10-year yields are higher for a 7th consecutive week. That's interesting to me, 346.89 at a time when so many people lined up to say the highs in June were the highs of the year. I wonder how many people, Lisa, want to take a nibble at that 10-year if we get back to 350, and we came close a little bit earlier.
There still are a number of people who are saying that we're close to the highs, but there are a greater number of people starting to raise questions about what kind of structural inflation there will be and whether the central banks will have the conviction to get back down to those target levels of inflation.
So yields up across the board and sterling weaker, the dollar stronger. Take a look at Cable 113. Citi out in the last 24 hours speaking to the team here at Bloomberg and making the obvious point, but I'm sure it will resonate with many of you. You can't buy fixed income because the Fed is hiking interest rates. You can't buy stocks because they're tightening financial conditions. And the only thing seemingly for many people to buy, Tom, is the US dollar and to stay in cash. Sterling, 113.92.
And retail doesn't have that. The people listening and watching here that are just worried about retirement plans, where do you hide? And one of the themes of the last 2 weeks is this idea of scale. There's no place to scale to. You've got a few choices, and that's it.
So the consensus view is everything we just said. Is it time to lean the other way, or are you worried about your head getting ripped off?
Exactly.
And Michael Hunt of Bank of America was saying just that. Like, sure, it's consensus, and yes, our fund manager survey says all of the above, but we think if you make new highs on yields, you're going to make new lows on stocks.
You put it really well. We're watching regime change. we're putting things into a new regime where rates are going to be high, where we have debt that is pinpointed to some of these low rates, and you cannot make these sorts of just move against the consensus kind of bets on their face.
Your weekend study, folks, quickly here. Consider West Texas Intermediate. It's $79 a barrel. We're not there yet, $85
now, sure.
But we're getting there rapidly, something for the American audience. Right now, on Europe and its impact on America, Sandra Philippin joins us, chief economist from the Netherlands with ABN AMRO. Sandra, thank you so much for joining us this morning. I want to talk about the rate flexibility that Europe has, given a dramatically different animal spirit, nominal GDP than America. I don't buy the template. Powell can do 75 beeps, then Lagarde can do 75 beeps. They're not the same economies, are they?
No, not at all. I'm glad that you mentioned that, actually, because sometimes that's a bit overlooked. So what we're seeing in Europe is an energy crisis that is clearly still intensifying. What we're actually expected to see in the coming months is that there's going to be a fall in real incomes that we haven't seen in decades. And that means that GDP is already expected to contract from the third quarter and then on to the fourth and into 2023, and at a much deeper level than the US.
Right.
And of course, the fundamental driver of all this is also very different, because this is an imported energy inflation that is driving the whole problem. And so the room for the ECB and basically the arguments that it's having are also very different. At the same time, it does result in indeed a very steep hiking path, and I guess there's no way around it.
Right. Sandra, one of the things I find, and this is my chart of the year, is nominal GDP set in US dollars for US, Europe, and Japan, and basically Europe's flatlined since 2009. Is there a risk here, even if it's at a more elevated level, of Europe getting into a eurosclerosis of 10 and 15 years, where it's not assumed a number of years down the road they can get a late 90s pop, that will not occur?
Well, that's actually a very complex question, but I think that what a risk that we're seeing indeed is that we might actually look at a Eurozone economy which is getting into quite a tight recession, but at the same time is not going to have the recovery, for example, that we saw after COVID. So it might be kind of a slumpy period after that as well. And then, of course, all the dangers around stagflation and all that is coming to mind. That is clearly a risk. It's not our best case.
You said that you expect a deep recession both in the Eurozone as well as the United Kingdom. What does that look like when it comes to unemployment rates?
Well, actually, unemployment rates have been rather low in Europe, and actually also in the UK. So one of the issues that we're basically facing is an economy at its capacity constraints. And that is also part of the inflation story. So if you think about, the trade-off between trying to tame inflation while trying not to cause a recession, well, one thing you could say is that if there's any moment where a recession, the pain of a recession is in a sense limited in terms of people getting unemployed, it's now, because we're having overheated labor markets, at least in the UK and in the north of Europe. In the south of Europe, it is a difference. So that's in Europe always a concern that there's this periphery and core different dynamics going on.
Well, to that point, how high can the ECB raise rates before it becomes a real problem when you watch the Italian yield, when you watch the Spanish yield, when you watch the Greek yields?
Yeah. We think now that that the 75 basis points in September will be followed by 75 in October, and then potentially another 50 in December, and that will mean we will be at around a terminal rate of 2%, and that then will be the peak. But of course, the risks of spreads widening is huge, and right. Therefore also the ECB has introduced this kind of new instrument. Yeah.
Sandra, what is the strength of core Europe theory as regards the ECB, how linked is Germany to the Netherlands, to Austria, etc.? How tight is that linkage to a Bundesbank heritage?
In terms of ECB policy, do you mean, or do you mean in terms of the economy? Yeah.
ECB policy.
Well, you can clearly see that the hawks have taken over at the ECB, right? So, if you look at the distribution of hawks versus doves, then definitely there's a hawkish tilt going on. At the same time, I think the arguments are the arguments will be going in the same direction whether you're a hawk or a dove. So this inflation situation is so extreme, you just have to hike. There's no way around it.
Sandra, wonderful to catch up. Expecting another 75 basis point move. Here was me a few months ago thinking maybe the full rate hiking cycle from the ECB would amount to about 75 basis points, and they've gone in one go. That's the change we're talking about.
It's just amazing. We used to think of a 25 basis point rate hike as radical. Now a 75 basis point is basically base case, and now people are talking about a 1% rate hike, and then others saying, hold on a second, you guys are moving too quickly and could break something, and this is sort of the real tension.
To some of the conversations we've had in the last couple days, do they become overcome by events off of a FedEx announcement, off of some, as we talked to Sandra about Dr. Philippin, off the idea of a run rate of sluggish GDP where everyone's like, yeah, I'm modeling out 2 years, we're going to see a lift. Says who?
Well, Tom, let's go based on their forecasts. They're not forecasting a recession. So if you want to talk about overcome by events, maybe overcome by reality might be the story for this ECB, because every other economist we're speaking to, can you think of anyone right now not forecasting a recession apart from the ECB?
No.
In the Eurozone?
No, I think that's a really good point. And even the CEO of Deutsche Bank, right, Christian Saving, came out and he said, sure, obviously there's going to be a recession, and the ECB comes out and says, no, it's good.
The change we've seen, Lisa, at the front end in Germany, I think has been remarkable. At the 1st of August, if you go back to the chart, you're looking at 27 basis points maybe on the first trading day of August on a German 2-year. A German 2-year right now, Tom, 159. That's what, 5-6 weeks later?
Yeah.
That's a lot of work done at the front end of the yield curve, not just in the States. We've talked about the 2-year Treasury, but on the Bund as well.
Very important on a lovely Friday in New York and around the Wall Street world. The pros worry about the calculus of it, the rate of change and the rate of change of the rate of change, and those right now are grim. I'm more optimistic, but the fact is the calculus right now is really ugly.
And that's why I was glad we had Danny Blanchflower on yesterday from Dartmouth. We could have predicted the tone that he would take, but he's getting increasing company. It's not just, for example, the likes of Jeff Gundlach, who came out and said that he actually prefers that the central bank, the Federal Reserve, raise only by 25 basis points. But you're seeing the World Bank come out and say, this is going to break the world. There will be a global recession because of what's happening. And these are some of the questions. Where do you go if you have to be a faith-based? And what the reality is saying is that inflation is hot and things are still going along just fine.
How far away are the October meetings of the IMF? It seems like months from now. I
agree with you. I mean, this Federal Reserve meeting has felt like it's taken months to get to. We're all waiting for a couple of CPI reports, a couple of payroll reports.
It did take.
A question many people are asking, I think we have to get better at asking our guests this question too, is this Fed being emboldened by a lagging indicator, the labour market?
I think that's a great question. Are they being emboldened right now by a government also that's basically saying inflation is at the forefront? And that's why I keep saying, if consumer sentiment hangs in, doesn't that embolden them further, right? Even though this is a lagging effect of when some of these interest rate hikes start to take effect in the actual economy.
Well, I tell you, if we get more strikes, consumer sentiment's not going to hold up for much longer in this country anyway, and it's rolled over pretty aggressively already. In the UK, Tom, a headline just moments ago, rail drivers at 12 rail companies, Tom, on strike from October 1st. So we talked about how it's all going to pause for a period of mourning in this country, and then it's back. It's back to business, and the business ain't great.
Thank you so much for bringing this up. Yesterday, I believe it was, it's a blur, folks, when you're traveling, but I believe it was yesterday, was the first day I felt like the middle 70s in at least 40 years.
It doesn't repeat, but it rhymes?
It rhymes, exactly. That was poetic.
I know, isn't it nice? A bit like Wind and Fire in that original song.
Should we play James? Let's do different James when we come back.
We've got the rights to play that music.
I don't
Just
know.
figuring it out in real time.
I called it. You know.
That's literally what we do every
It's the floor manager, Sarah, us straight away. Have you got the rights for that?
Someone's
The
on
governor
top
of
of
Florida's
things.
going to.
Welcome to the program.
The governor of Florida is going to fly me to the vineyard to talk to James.
Tina Fordham's going to join us shortly from London. This is Bloomberg.
They're having too much fun. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, President Volodymyr Zelensky says a mass grave has been found in a city that Russian troops abandoned last week. More information is expected today after a visit by journalists. Meanwhile, President Biden says the U.S. will give Ukraine as much as $600 million in additional weapons and ammunition. The aid will come from existing stockpiles. A retired federal court judge has been named as special master to review 11,000 documents seized at Donald Trump's Florida home. The special master has until November 30th to complete the review. Meanwhile, the judge in the case has refused a government request to use documents with classified markings in a criminal investigation. In Europe, new car sales rose for the first time in 13 months. Registrations increased 3.4% in August. Mercedes-Benz was among the best performers with a 16% rise. But the good news for many automakers may not last long. Record inflation and unprecedented energy crisis threaten to discourage buyers. Apple is counting on upscale shoppers to make the latest iPhone a hit when it goes on sale today. The iPhone 14 lineup reserves the best features for the high-end Pro models, costing at least $1,000. Now, based on pre-order sales, that strategy is working. Consumers have turned the most expensive new iPhone into the most popular version. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I am very supportive of the idea of an oil price cap in general for Russian oil. We are working on amending the sanctions package that is required for this new proposal, and we know that we have to be fast on that one. And of course, sanctions always need unanimity.
Ursula von der Leyen there, the European Commission President, live from London. This is Bloomberg Surveillance. Your equity market healing just a little bit, but still down, negative lower by 0.75% on the S&P 500. Yields higher by a couple of basis points on a 10-year, 346.89. Euro dollar negative 0.2% and 99.80. A couple of things to pick out. The 2-year, the front end of the Treasury curve, through 3.90. Earlier on this morning. I'm getting used to saying it, Lisa.
I know.
Getting used to saying sterling at 113, the 2-year at 3.90.
So yesterday, Tom kept saying, when do we start playing the 4% 2-year
We're here.
game? Is it going to be for 3.90? And we're here.
We're
And this was one day. Yesterday, you were like, we're not there yet. Today, it's, we're
We're
there.
playing 4% Fed funds over at Deutsche Bank.
Yeah.
We're going to give you more data today, as we always do, but particularly I want to frame again 200 business days of the year. This is one of the 5 days. It's truly ginormous. And I want to mention, John, what hasn't moved, which is yen hasn't moved. It's locked out of fear that they may actually do something about their busted auction
Well,
policy.
they have to do something about that yield curve control story.
But, I'd extrapolate out yen ought to be 145.46. It's not. It's a 143 level just because of the effect of the
You think
policy.
we're getting to that point where it starts to bite?
Yeah, I think, okay. I do. I think on this Odd Friday, we welcome all of you worldwide, and of course here in London on a most somber week, and we move to the funeral of the Queen on Monday as well. Right now on international relations on the Shanghai Five, Tina Fordham joins us, founder geopolitical strategist at Fordham Global Foresight, and this could be a 1-hour conversation. Tina, I'm going to distill it into the Shanghai Five, and then there's the Moscow One. How lonely is Vladimir Putin into this weekend?
It's been awkward for him, right? I mean, I think the image that captured it for me were the leaders of the Shanghai Cooperation Agreement standing, and Putin standing a little bit on his tiptoes.
I do that all the time. I mean, I can say that.
Well, this is the leader who took his country into a special invasion, massively miscalculated, and is now starting to feel not only blowback and setbacks on the battlefield, but almost incomprehensibly for Putin, who's been in power for so long now, calls for his resignation. Usually when a leader goes on a foreign trip, it's it's a photo opportunity, it's an opportunity to distract and deflect and take some nice photos. And Putin ends up looking a bit apologetic. Russia ends up feeling like a kind of a vassal state to China.
I sensed from the serious tone you're taking, you think this is more than just a diplomatic dance. Can you think of the immediate policy implications from something like this?
So this is the kind of thing that is important for market participants, but not a game changer, right? It's diplomatic mood music. We're in a period, an inflection period, right, whereby there is a rebalancing. If you are Turkey, certainly if you are China, but also other countries that weren't represented at the Shanghai Cooperation Agreement, like India, Saudi, South Africa, Brazil, etc., you're watching to see what China does with Russia, how Russia fares in terms of the costs that are imposed for this conflict, because any kind of a sense of a new revival of the old Cold War non-aligned movement is looking pretty bad now that Russia has taken such a pasting. Yeah.
Although there is a sense that Vladimir Putin has been backed into a corner, and what's the consequence going to be with the whole Ukrainian conflict? Will he go harder in other areas? What does he do to save face if he's willing to stand on his tippy toes? The image that you basically put. What's the policy implication of that? What are the potential ramifications from his position currently?
Well, this idea of a kind of an authoritarian leader with nuclear weapons being backed into a corner is a very concerning scenario. When we look at Putin's past behavior, and remember that he's taken Russia into conflicts in Syria, in Georgia, and now in Ukraine, twice in Ukraine, he does tend to double down. But most of the military strategists that I talk to don't think that he's likely to use a tactical nuclear weapon. The shorthand is TNW, or maybe a chemical weapon. But we see all of this activity, shelling around Ukraine's nuclear plant, and so the risks of an accident are there.
How concerning is it that there was some sort of meeting of minds about Taiwan, from Russia backing China's vision of Taiwan as part of that nation? How does that sort of affect your view of what's likely to play out there?
Well, as we sort of talk about hard power, soft power, signaling, all this international relations terminology that's really in focus here, the attempt is clearly to signal that the powers assembled there support China's one China policy, including Taiwan. Now, behind the scenes, a lot of military intelligence types think that what China has taken away from the way that Russia's fared in the Ukraine conflict is it needs to move sooner rather than later in Taiwan, because that window of opportunity, if indeed there is one, is narrowing.
You are one of the few that truly have a transatlantic understanding and are encyclopedic on the international relations of the United Kingdom. Charles III today will travel to Wales, as he's traveled to others, 1,500 miles, I'm told, just in the last number of days. How united is this United Kingdom under Charles III?
Well, you're here at a fascinating time, right? And I'm a dual U.S.-UK citizen. I've been here for 20 years, and so I have that thing that immigrants have, kind of seeing things in more than one context, which is really helpful. I have to say, though, I'm an analyst and not a kind of a monarchist or an anti or anything else. And I look at this as through my U.S. political science hat, and I see that the U.K. has something that we don't have in the U.S. right now, where we have low trust in all institutions, from the media to the Supreme Court. Only the military, U.S. military, is trusted. You can, parse the support for the monarchy amongst different age groups, but even a majority of so-called ethnic minorities support the monarchy as an institution. The way I think about it is how this played out during the pandemic, where in the U.S. we had kind of viral videos of people in Costco saying they're not going to wear a mask because it's a violation of human rights. We just didn't have that here.
People just didn't wear masks.
Not exactly true. But what you have
in the UK as
is
well.
what political scientists call social cohesion, and that's the willingness to follow rules. You've got people queuing for the queue. It's extraordinary.
I sense
and
that
totally
in the UK,
non-American.
it wasn't politicised here in the way it was in the United States. That was my impression of things.
Well, and that's what polarization will do. It's considered more, you know, these are kind of forces of nature almost. Now, there will be changes as a result of this transition of power to King Charles III. No doubt about it, but not abrupt ones.
I wasn't in this strange position because I was in both London and New York during the pandemic. When I was in London, if I saw someone with a mask on, I wasn't like Democrat, and then saw someone without one and thought Republican. I thought, what was that about anyway? Well, here in London, you just chose to wear one or not to wear one without any real political affiliation behind it.
I just asked that because Tina's fronting for us to move over here. Bring the whole show over.
I think you're
here.
trying to push for that one. Tina Fordham of Fordham Global
I never looked back.
Core inflation keeps rising, keeps surprising.
The Fed's going to lose its case to keep raising rates, maybe sooner than we think.
We're still leaning towards 75 just because I'm not sure Powell wants to do shock and awe.
I think the bigger issue maybe for the Fed, and they won't talk publicly about it, but it's the strength of the dollar.
If you start to push back against a strong dollar, you're effectively saying the Fed should be hiking rates as aggressively. That is a problem in itself.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Wind and Fire would be a great soundtrack for the price action, don't you think? Just thoroughly depressing,
I think it would be Fire and
downbeat.
better.
Equity futures down 7/10. Live from London this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. TK equities lower, the dollar stronger, yields higher at the front end. We had a little look at 390 on a 2-year.
A little bit, right. Well, we're at 390 right now. I just looked over at the Bloomberg terminal, and there we are. And what's important here, folks, is out of 200 business days of the year, this is one of the 5 that matter. This is a correlated mess. We could talk about it all through the show. A wonderful guest qualified to talk about the correlations that are going on, John, and almost without fail, everything's linked together.
A correlated mess with a real-world impact and consequences, whether it's mortgage rates of 6%, Lisa, we can talk about that later, or FedEx. FedEx comes out and says, sorry, our guidance was wrong, and the stock's down 20% in the pre-market.
So this is the big issue, right? How many more of these do we have to go? And you were saying this earlier. This is Mike Wilson's world. This is what he's been predicting, and this is what a lot of people have been saying. You're just too bearish. Look what they have been doing. But is FedEx the new norm as we take a look at the consequences of some of these rate hikes?
We're experiencing the rate shock. Tom, is the earnings shock up next?
Well, the earnings shock will also be a revenue shock, and this is you know, the soup is the word, and it doesn't really fit here. But the bottom line is, inflation's moving. We don't know. The real economy's moving, we don't know. And so you've got a complete mystery in the last week about what revenue will be that comes down the income statement to any way you want to define earnings and cash flow.
No mystery about this right now. This equity market heading south, lower down, negative 0.75% on the S&P 500. Little bit better than where we were.
Better than an hour ago.
Where we were earlier. Yields are higher by a couple of basis points on a 10-year. 346.69 on 10s. Euro dollar 99.87, negative 1/10% there. The dollar fading just a little bit again in the last hour or so, so not as brutal as when we first came into the office. What time was that, Tom?
I got here, you know, on the U.S. clock, 6 a.m.
Do you know what he did
5:52
today at breakfast? What? Stormed out of the hotel. Stormed out of the hotel.
Well, let's talk about this. This is the metaphor.
He was upset about the service.
No, but no, I was not. That's not accurate. This is important, and this is a metaphor for all of you in America. It's the same in London. You got 213,000 claims, and you got a restaurant that's supposed to have 6 people there, and they had 2.
I was picking up the pieces. Do you know what they did for him?
What'd they do?
They said, "You're his boss." I said, "Yeah, I know." And they said, "Take some pastries for him and cheer him up." So I brought him some pastries.
Great.
Do you feel happy?
Yeah.
No, he had the I can't do it.
No.
For those of you in radio, I'm holding
Danish.
the big tray like the waiters. John brought over the full English. It was great.
Chocolate croissant. Anyway, futures are down 0.8%. Bramo yields are higher by a couple of basis points.
All right, let's do the brief for you. Tom Keene stormed out of breakfast today. Stay tuned for dinner. No, today, day 2 of China's Xi Jinping and Russia's Vladimir Putin meeting. Yesterday, I found this fascinating. Vladimir Putin said that he understands Beijing's concerns and questions about the Ukraine invasion, basically acknowledging that it was controversial, splitting these 2 allies that had made a pledge ahead of the pandemic that promised to increase increasingly get close ties together. 8:15 a.m. This I am fascinated for. Colombia's Finance Minister Jose Antonio Ocampo is going to be joining Bloomberg Surveillance to talk about the ramifications of the Fed's rate hiking cycle on the rest of the world. How does Colombia respond? How do they raise rates and continue to raise rates at a time when they have to deal with, yes, inflation above 10%, but also the consequences of a strong dollar and threats to their economy? And at 10 a.m., we get a sense of how we feel. University of Michigan Sentiment Survey for September. How do you feel?
I don't know. They're about to ask 600 people on the phone, though, and we'll find out.
How do you really feel about this survey?
That is the survey, isn't it?
I mean, so I think this is interesting because will it be a good news story if this people feel good? Probably not, because it'll give the Fed that much more ammunition to say, look, things are actually going along.
I don't think they look at these surveys.
They told us they do.
Told us that they did.
I don't think they look. Clarida will say they're driven by math and models. And I don't think they look at the
Clarida's going to speak for himself next week on a Fed show. Look forward to that. Can I tell you, it's so great to have people alongside us. Andrew Sheets, one of them, just dropped by from Morgan Stanley, the Chief Cross-Asset Strategist. Andrew, it's good to see you, Mr. Sheets. When can I buy this equity market?
Well, thanks. It's nice to be with you. It's nice to be with you in person. Look, this is an equity market that I think over the next month is still dealing with a real crucible of challenges. We are into the thick of what we think is going to be a disappointing earnings revision lower. That's a key view of my colleague Michael Wilson in the U.S., my colleague Graham Secker here in Europe. I think this is still a period where it's going to be very difficult for the Fed to sound anything other than hawkish, given these upside surprises to inflation. And then on the geopolitical front, right, it's too soon to get anything real developments in terms of changes in China policy, and still a lot of uncertainty into European energy policy heading into winter. So we think it's still too soon, especially with rates rising, especially in the front end, and think investors should stay cautious. And we think that cash will outperform a lot of assets.
There is, at Brown University, a fabulous tradition of differential geometry. Cornell and Brown on the high ground on that. And it all comes down to calculus. Are you frightened by the rates of change right now in the second derivative as well?
Well, I think the biggest change that I think the market is going to have to adjust to is, investors over the last 12 years, which is a quite long period of time, have known mostly rates of 0 or less than 0 on cash.
Well, Nassim Taleb said this out on Twitter yesterday. He said it's like physics without gravity. Are we getting used to gravity again?
I think we're getting used to gravity. I think we're seeing a real large adjustment. So if you think about the S&P 500 having an earnings yield of about 5.9%, and 1 to 5 year corporate bonds having a yield of 4.9%, that is an enormous convergence in cross-asset yields. And that's a shift we haven't seen for 12 years. So I think that's an adjustment that is truly different and that the market's going to have to, make some adjustments for.
There's a difference between more downside in risk assets and something breaking, and something that becomes a systemic issue that is a fissure and that is rapid. When does something break as we take a look at that pace of change, particularly with the front end rate?
Yeah, so Lisa, I think that's such a great point, because I think ironically here, the fact that stuff is good, i.e. not breaking, means that the Fed can and likely will do more. I think we see banks with very healthy balance sheets. We see consumers and corporates with healthy balance sheets. The low rates of the last 2 years allowed a lot of Americans to refinance into low 30-year fixed-rate mortgages, which means their largest liability, their highest cost, is almost immune from the rate hikes. And so that strength, I think, means that the market is sending the Fed signals you can keep going. We haven't yet hit that point where it's disorderly.
So what is that point? I mean, can they get up to the Deutsche Bank call of 4.9% on a Fed funds rate and still have things be sanguine enough to give them some confidence that they can stay there for a while?
Well, so we don't think rates will get that high, but we do think that the skew is that they will continue to press higher and go for longer. And again, I think the Fed is having a real challenge, right? In hockey terms, they are trying to skate to the puck, and we don't know exactly what the delay between a rate hike today and an impact on the economy is going to be. And so this is a real uncertainty. I think the market was hopeful that we would get some relief, that inflation would start heading in the right direction, and that would buy the Fed some time. But I think it's quite clear with that sticky core inflation, they just cannot pivot yet, and then the skew is towards tighter policy.
Is that the anti-Gretzky? Is that what that was? Do you like that? You're proud of me. You're so proud of me.
I'm going to tear up here.
I know.
Get the spelling right on that banner. I mean, I saw Gretzky actually do this. This is absolute fun.
I knew that would get you going.
Where he was playing the Buffalo Sabres in Perot, and Gretzky did exactly what you said. Jerome Powell is no Wayne Gretzky, is he?
Well, I do think what you're dealing with is, if you ask a lot of economists, right, there's not an agreement on what that delay between a rate hike today is on the economy. And then I think there's still very divergent camps, theoretically, right? I think there's a camp, and we heard this last year, the Fed can never hike very much because there's so much debt in the economy, they'll never hike more than 1 or 2%. Versus, well, actually, maybe companies and households have termed out so much debt at super low rates that the sensitivity is lower. And I think this is a real question that you kind of don't really know until it makes contact with the economy.
So, Andrew, we came out of the last crisis in 08-09, and you all remember the projections for high yields every single year. High yields, never materialized, yields went lower. Do you sense it's that kind of story in reverse, that we haven't quite fully capitulated on this view of a low interest rate world, that we just seem to think that this is an anomaly and we're going back to where we were before?
I think there's still some of that, and I think the real rate is a very interesting debate, where real rates are still quite low. In the U.S., in the Eurozone, in the U.K., they have not yet gone back to kind of just the pre-GFC level, let alone kind of the higher levels we saw in the 90s. So I think there's still room for the market to readjust, especially as you see a healthy household, healthy corporate balance sheets, more capital expenditure that, again, could point to kind of higher, somewhat higher, neutral levels of interest.
I put out that Deutsche Bank call from Matt Lazzetti, 5% Fed funds next year. The amount of pushback I got on that call, just because people wonder whether we can actually live, Lisa, and you've spoken to this a few times, in a 5% interest rate world anymore.
Yeah, and I think that Andrew Sheets' point, saying that basically people have termed it out, and the fact that they are coping with it gives this uncertainty of maybe we have gotten less rate sensitive and allows the Fed to go further, is really underpinning the reality of what people are pricing in.
You know how you try and get me to explain football to people who don't know football? Can you explain Gretzky
Why are you
to
looking
everyone?
at me?
Can you explain Gretzky to everyone?
No, this is, I'm going to tear up
to where
here,
you think
folks,
the puck is going to be.
Everybody
Here's
knows.
the puck.
I mean, everybody knows I know less about English football than
What
Guy
do I know
Johnson.
about ice hockey?
But you're dazzling me. How do you know that Gretzky skated to where the puck wasn't?
Because his daughter married a very, very good golfer. So I sort of reverse engineered it from golf through his wife and back into ice hockey. That's how I did it. Does that work for you?
I have a lot of questions.
Does that work for you? So sort of reversed engineered it from golf to ice hockey, and then learn about that famous quote. Tom, it takes a lot of work. Andrew Sheets of Morgan Stanley. Andrew, thank you. It's good to see you. Equity futures down 0.8%.
Gretzky was data dependent.
At the corner of my eye, Guy Johnson just turned up behind the camera. We're going to catch up with Guy on a pound sterling that hit the weakest level since 1985. The strikes are going to be back in October on the railway.
Big deal.
And we need to talk about, what is it, the 30th anniversary of Black Wednesday?
Black Wednesday, 1992, and it really is a poignant moment considering where sterling is
Bloomberg's
today.
Guy Johnson, a few minutes away, live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The economy in China showed signs of recovery last month. Industrial production, retail sales, and fixed asset investment all grew faster than expected. Meanwhile, the urban jobless rate fell. Beijing had rolled out stimulus measures to counter a slowdown. Still, a property market slump and COVID lockdowns are weighing on the outlook. In Germany, the government has begun what may be a series of historic takeovers to try to avert a collapse of the energy industry. Regulators are taking control of Russian oil major Rosneft's German oil refineries. Now, Germany's also nearing a decision to take over Uniper and 2 other larger gas importers. The White House is calling on Republican governors' efforts to ship migrants out of the state cruel and shameful. Florida's Ron DeSantis flew dozens of migrants to Martha's Vineyard off Massachusetts. Greg Abbott of Texas sent 2 buses to Washington near Vice President Kamala Harris's home. Republicans say Democrat cities should help handle the results of President Biden's immigration policies. It's a potentially worrying sign for the global economy. FedEx has withdrawn its earnings forecast due to worsening business conditions. The package delivery giant pointed to weakness in Asia and challenges in Europe. FedEx is taking immediate steps to cut costs, including parking some aircrafts, cutting workers' hours, and closing more than 90 FedEx office locations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think that if the Fed's going to manage monetary policy on the basis of what was the hottest report in the last 30 days, I think they're going to make a big mistake. I think the Fed's going to lose its case to keep raising rates, maybe sooner than we think.
That's the hope from the equity bulls, that maybe that's the case, and Jim Paulson is not alone. The Luthold Group Chief Investment Strategist, live from London this morning. Good morning. Here's the price action. We're down 8 or 9/10% on the S&P 500. We are in Mike Wilson's world over at Morgan Stanley. He was looking for the corrections to come from earnings scares. And here's one. FedEx in the pre-market. I think we can use the word crushed. Getting absolutely crushed in the pre-market, down 20%
worse than
in
an hour
early
ago.
trading. And here's the quote from the CEO. Notice the word speed. Things are moving quickly. We are swiftly addressing these headwinds, but given the speed at which conditions shifted, Tom, first quarter results are below our expectations. That's the FedEx CEO. Are we going to see more quotes like that in the coming weeks?
And the deception here with Jim Paulson is very simply here that the consumer's been acting buoyant. We've seen some good things like claims yesterday the bulls are trotting out. But I would just this is very important, folks. Through the day here on Bloomberg, on radio and TV, this is a different Friday.
They're the kind of quotes that spook people, though, Tom.
Yes,
when you
absolutely.
get a CEO that comes out and says,
Absolutely.
didn't see this a month or so ago, seeing it now and it's happening fast.
And maybe it's an old FedEx, a new FedEx, whatever.
Sure, perhaps,
the fact is, there it is. This is a joy. We rarely get to sit with Guy Johnson. John, I want you to bring
doesn't
Guy
like us.
Johnson. You guys have known each other for years. There's just so much going on here. Away from the funeral on Monday, this is a United Kingdom, John. It's almost like it's reliving the 70s.
We used to have a show together and then you broke it up. I had to come to work with you in New York. Guys, good to see you, buddy.
Sorry.
I know.
Pre-Keene.
You're just in between us. We'll talk through you. Guy, 1985.
What's new?
1985.
Can't talk over you.
The 30-year anniversary of Black Wednesday. What a moment for pound sterling going into the Bank of England next week.
The irony is that we are below where we were then. So we're at 90.85 levels, not 92 levels. So the pound is being hit incredibly hard here. The catalyst this morning, retail sales. You look at that sales number. The consumer here hit a brick wall ages ago. But it is now hit the brick wall, gone through it, and is hitting another brick wall. And it is really rough out there. Somebody described this chart as a crocodile. Basically, you've seen the value of goods go up because of the inflation number, but the volume of goods go down. The consumer is being hit hard. That probably makes the Bank of England's decision 50 basis points rather than 75 basis points.
Chris Giles in the FT today scathing about the growth initiative of the Chancellor. What is the labor opportunity here for the Americans, Tory, Republican, Labor, Democrat? What's the labor opportunity to respond to what appears to be a crisis?
The election is a long way away, so in some ways you need to characterise it in that way. The Labour Party certainly will make much of this. What would the Labour Party do differently, I think, is the interesting question that needs to be asked.
Better than my question. Why don't you answer?
Tom. And that is the difficult bit to figure out here. This is a large, in many ways, an external crisis with some really big internal elements to it as well.
We were talking about what happens when the Bank of England comes out and hikes rates by 75 basis points. Does that lead to some support for sterling, or does that really lead to a further leg lower, another brick wall, because it slows growth that's already slowing at a time of a lot of pain?
Yes. It will not cause the currencies to be supported in the way that it would have done in isolation. So given the fact that what's happening with the Fed, given the fact that we're talking about 75, 100 basis points, that's the starting point. The UK economy is clearly in a lot of trouble. And you've got, what I think is interesting here as well is you've got the fiscal and the monetary pulling in two different directions.
Right.
But the UK, next week we're going to have, to Tom's point, the Chancellor laying out a 2.5% growth target. How do we get there? I have no idea. Targets are great, fantastic, lovely. We're going to have a strike that is going to start. Right. You've got a Bank of England rate decision. None of this is particularly positive.
Let's talk about that strike. What is the reason for it? Is there more like it that are coming? What is the goal and some of the tensions that really highlight what the energy situation, what the inflation situation is doing to the broader economy?
Cost of living squeeze, we want more money. That's the kind of the starting point for it. But there is a paying conditions element to it as well. It's a bit like the rail strike that's just been averted in the United States. There is clearly a kind of wage element to it, but there's also we want more sick days. We want to manage how guards are positioned on trains. There's a whole range of other issues. Fundamentally, though, it's a wages issue.
Is there a parallel in that we just had, I believe the statistic is a 24% lift in American railroad compensation over 5 years? Are we going to see that kind of jump in rail labor wages in England? Unlikely. US rail, hugely profitable. It can distribute some of that money to labour. The UK rail network is a little bit of a mess, if I'm being honest. It is not managed in the way that it should be managed. It's theoretically private, but effectively public, and as a result of which, it is quasi-government. And you're not going to see those kinds of numbers, Tom. You may see significantly higher numbers that you would have seen recently, but you are not going to see those kinds of numbers.
Okay, what's more interesting to you then, if you had to pick one? Is it the budget? Is it the fiscal response to all of this? Or is it the Bank of England next week?
If I had to pick one, I think the biggest struggle now is the Bank of England. I think the near-term currency issue, I'm not sure how concerned they are about the currency, but I think it is a factor.
It must be getting more concerning, guys.
It's imported inflation, isn't it? You think about the energy story, it is imported inflation. We pay for our energy in dollars. And as a result of which that is going to be a factor. It doesn't appear to be that they are concerned about that. If you want to fix this economy, there are massive supply side reforms that you need to introduce. We need to re-establish the relationship, think about the relationship, develop the relationship with the EU. All of that is what is necessary on the quasi-Kwarteng front. Are we going to get any of that? Unlikely. Therefore, I'm probably more interested to see how the Bank of England navigate what is an incredibly difficult decision, 50-75. How much damage do you want to do to this economy? How much do you need to slow it down? How much do you need to slow the car down? Because at the moment, it's rattling badly.
Can I throw this in there just in 30 seconds? What do you make of the Big Bang 2.0, 2.0 here in the City of London?
It's going to have to go a lot further than getting rid of the wage cap.
Sure. I'm wondering what's next.
It sends a signal. I think this is a communication device.
Yeah.
And to your point, a lot needs to come next if we are going to see the City of London becoming more.
I know what Big Bang is.
There you go.
Yeah.
What does Jamie Dimon and JP Morgan want out of Big Bang 2?
Well, I think in some ways they're getting what they want up front. The wage cap is useful for them in as much as it makes the pay story a lot more flexible.
Looking back to the 1980s and 1970s.
Should I just, next block, should Guy just move over one chair?
I brought you a pastry and everything, and you're still not happy. In fact, you've got two pastries.
Please, I'm in England. I'm not happy.
Come on, TK. That's unfair.
I thought you loved it here.
Live from London this morning. Good morning to you. Here's your equity market. We're down 0.8% on the S&P. It improves just a little bit, TK. The dollar move earlier this morning fades. We saw some real powerful dollar strength. That fades just a touch. Euro dollar 99.82, negative 0.2%. Yields higher on a 10-year by a couple of basis points, 346.50. Check out the 2-year. Not just on the session, but over the last 5 years. This chart is a deep, deep valley.
Great chart.
Crushed, cratering into the pandemic, and then yields coming out of it absolutely surging through 350, which was the high back in June, through 360, through 370, through 380, and briefly this morning, for a heartbeat, a moment, Lisa, through 390.
You were saying this yesterday. We've seen such a huge reset in the 2-year yield, and yet we have not seen the commensurate lows that we saw back in June. On equities, why not? What is the distinction between now and then that people are seeing? And I think that that's a question that we should all keep asking.
So we're more than 6% off the lows of June, even though 2-year yields are, 40 basis points or so, more than 40 basis points off the highs back in June. Not for me to make a market call. Michael Harnett of Bank of America is doing that for everyone. He's come out and said if you're going to make new highs on yields, he expects to make new lows in stocks. Futures are down, Tom.
And they break down sector to sector and across different kinds of companies. The cash flow generators have done better. But the FedEx number today, bring that up if you can on television. For those of you on radio, all you got to know is -20 and the decimal points behind the zero. John, FedEx down 20%.
That's brutal.
Stunning.
Tom, corporate earnings can be frustrating sometimes because you can pick a corporate earnings, a report, maybe a new guide, a cut to guidance, and get it to say whatever you like. When it's FedEx and they talk about things like speed, this is happening really, really quickly, that's going to spook people. And I imagine it's spooking people this morning. It's certainly spooking the people that hold the stock when you're down 20% of the pre-market.
And especially if it's a bellwether type of company that is at such the heart of the nexus of so many different aspects of commerce in the nation, like FedEx, transporting packages from one place to another.
A guy came to set just moments ago, and before he sat down, he said, you need to look at DHL, you need to look at Royal Mail, look at what's happening with the European names as well. That story out of FedEx is spreading into Europe too.
It is. And over to Asia, which we've hardly touched on today, there's some immense challenges there with renminbi solidly through 7 yuan per dollar today. Right now, with your most important brief of the day on fixed income, Subrata Rajappa joins us, head of United States rate strategy at the French bank Societe Generale. Their history of math derivative dynamics is world class. Subrata, thank you for joining us. When you look at the derivative mathematics of what we've seen in the last 2 days or even last 2 weeks, what is a telling story about the rates of change in fixed income?
It's stunning. I mean, we were looking at, if you look at a chart, and I think John was showing the chart earlier of the 2-year, we've gone somewhere between 20 basis points last year this time to close to 4% right now. So the rate of change has been just absolutely stunning. To me, what I'm looking at is the message that you're getting from the bond market, which is, to take a page from, I think Facebook's, motto. It's like move fast and break things. That's kind of what the Fed is about to do, which is if they do go along the path that the market has laid out, they're going to have to break things ultimately, and that's what the curve is really suggesting to us.
I got 8 ways to go here. I'm going to go pro on you right now, Subhadra, and that's of all the different spreads. There's that one across all of the yield curve. The 2-year, you go to 3 months, but let's take the 2-year to the former benchmark 30-year bond. It is at a place we literally haven't seen almost in a lifetime, 2000. What is the importance of the level of inversion of the 2s30 spread?
Absolutely. The 530s, the 230 spread is really at levels we haven't seen in 2 decades. So to me, what the message there is that the market ultimately, if you look at 10 years and beyond, is looking at the potential for a meaningful slowdown in growth and, perhaps a hard landing, especially if the Fed hikes rates as aggressively as what's priced in the market. You're looking at a terminal Fed funds rate right now around 4.5%. I mean, that level was at 4% or below just before the CPI print this week. So the move and the repricing higher of the terminal Fed funds rate has been quite dramatic in a very short amount of time. So that would mean that there's a potential, much higher potential for a hard landing.
Lisa, I'm going to tear up here. What a control room we have. Qantas and the crew, they throw up a 2s30 spread chart. No one else in financial media does that.
Can you stop referring to our Australian producer as an airline?
I mean, to see the 2s30 inverted live on television. For those of you on radio, it's just an act of God. It's just wonderful.
What am I, BA?
Definitely. No, he rejected BA a little bit ago. No, Subhadra, let's get back to the bond market. I think that's a safer place for us to sit on. Maybe, although maybe not. The question is, where do we stop, right? And where do we stop not only with 2s, but also with 10s, given that people are wondering, are we going to break something? And what does the post-breakage look like? Are we still looking at a higher inflation rate, at a higher real interest rate in an era where we're not talking about zero yields anymore?
Yeah, no, I think that really at this next meeting, given how dramatically yields have risen, I'd be looking to hear from Chair Powell on what they think their policy path is going to be. And in my view, at least, I feel like the market has gotten a little bit ahead of itself, and Powell might have to thread the needle and try to sort of talk the market away from the ledge, if you will. Because, yes, they do want to front-load rate hikes. Yes, they do want to get to 4% in a rush, but I think that they're going to take a much more measured approach beyond 4%. To make sure that they're not breaking things as they're raising rates. So it's going to be a balancing act between what's happening on the employment front. You spoke about FedEx earlier. They'll be looking at a variety of metrics to see what the impact of higher interest rates are on the broader economy. They know that monetary policy acts with lags. So they're going to have to figure out what that lag is and how to act now so so that the monetary policy transmission is effective and doesn't break things over the longer run.
Subhadra, does that mean that you're in there buying 2-year bonds?
Buying 2-year bonds? Not necessarily. I mean, I think the Fed is not going to be, buying bonds anytime soon.
I'm saying, sorry, excuse me, Subhadra.
Oh.
I'm just wondering whether it's a good opportunity, whether we basically have seen a peak. If you're going to expect a Fed to push back and give the market a little bit of assurance that perhaps they've gotten ahead of themselves, does this mean there's an opportunity in short-term debt?
There might be. The question is whether you want to enter into that trade now, perhaps leg in. If you start getting, closer to 4% and 2s, I mean, yields start looking very, very attractive. I think you're going to see perhaps a little bit of a tactical steepening between, say, the 3-year and the 10-year part of the curve. I'm still afraid to touch the 2-year part of the curve because it's pegged to Fed expectations and has the potential to move higher.
Right.
But I would say tactically positioned for, say, a 3-year, 10-year steepening makes sense to me, at least over the short term.
All right. Subhadra, it's away from your remit, but I'm going there. It's a Friday. No one's listening or watching. What do you do with a 60-40 allocation in bonds? I mean, come on. In this world, with these rates of change, I look at the Bloomberg Total Return Index, and 60-40 is getting absolutely crushed.
Absolutely. I think that, all assets are very correlated right now. You're seeing, bonds sell off, equity sell off, the dollar continue to tighten. At some point, when you've seen a significant move in risky assets, the best place you want to be is going to be in bonds because yields are looking very, very attractive across the curve. Even in the long end, even though yields haven't risen as much as they've done in the very front end, you still see pretty consistent demand from asset liability managers and pension funds for the very long end. So I think that sort of trade is here to stay, and that's going to keep long end yields, somewhat, pegged. And, it makes sense because if you're looking at a much longer term horizon, you probably want to be long bonds, especially at a time when equities are performing very poorly.
Subhadra, we've got to leave it there. Thank you. Subhadra Japa there of SocGen on the latest in this bond market. The game changer here, guys, and you know it, it's 390 on a 2-year. When we spoke to Oksana Aronoff earlier this week over at JP Morgan Asset Management, how big was her cash allocation in her portfolio?
70% liquidity.
70% liquidity. 390. I think the message she's basically saying is, I'll take 390 on 2s. I'm not willing to take the duration risk of 350 on 10s.
Right.
Because at the moment, given everyone's saying, yes, and Subhadra's point, there will be people that come in and buy at 350, but I would be nervous too. 7 weeks of consecutive gains on a 10-year yield when everyone was lining up to say we've seen the high. And they thought we'd seen this peak hawkishness, this peak inflation story, and then core month-over-month inflation accelerates again. It makes people nervous.
But here's the interesting tension in the bond market. You're getting yield. You haven't gotten yield for so long, and that's the reason why the likes of Oaktree are seeing equity-like potentials in credit. That's why you're seeing Jeff Gundlach come out and say the same thing.
Got a bearish growl from the other side of me.
I don't know, rhinoceros bear. I mean, honestly, I wonder whether other people are saying that too. If you actually can get yield, if you sit on it, you actually get those returns.
If you sit on it. Yeah, this is so important, and it's so much of what we do, John, at Bloomberg and Surveillance is fancy pro bond talk. Individuals listening and watching who are just looking at price of an individual bond, pick the bond.
You said it, Tom, hammered.
If it's a Greg's 10-year bond on sausage here and whatever it is, the answer is it's price down, yield up. And you mentioned earlier the mortgage market in the United States. I got on the Gulf Stream to come over here, and I wasn't looking at a 5.8 or 5.9% mortgage, and now it's 6.2%. That's no different than what somebody's bond statement looks like.
So when are we going to start to see that actually really smash around house prices?
We're there.
You think right now?
We're this weekend. We're there. It's why I was in Knightsbridge yesterday. I'm sorry. I'm just trying to keep up with Ferro folks.
This weekend, he's trying to get some price cuts. Is that what you're trying to do? This
Lisa,
weekend,
seriously.
cut the price.
Look, when Euro went down the last time, America bought the island south of Notre Dame, Ile de Cité. I can't remember the name of it. Why is this any different?
Hey, Tom, you make
Why
a
are we
serious
going to buy
point.
acreage in Knightsbridge?
It's a valid point. In the United States, and this breathes some life back into the conversation we've been having all morning. Matt Lazzetti at Deutsche Bank. I'm going to keep ignoring the Knightsbridge line. Matt Lazzetti at Deutsche Bank talking up 5% interest rates. We're looking at 6% mortgages. And the pushback we get against that, the continual pushback we get against that is, can we live in that world?
the issue is, and the housing market is a perfect example, it is not leveraged to the degree that it was ahead of the 2008 crisis, so you don't see the sudden fissure that you did last time.
Guy Johnson wants me to live out halfway to Manchester or Liverpool, wherever he lives, except the property comes with 24 sheep.
It's towards Surrey.
Okay, well, I don't know where Surrey is, with the fringe on top.
The
property comes, what am I going to do with 24 sheep?
What was that growl when Lisa was speaking?
Oh, I don't buy it for a minute.
Well, no kidding.
I'm sorry, I don't buy it for a minute.
Growled at me.
Live from London, this is Bloomberg.
24 sheep?
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, President Volodymyr Zelensky says a mass grave has been found in a city that Russian troops abandoned last week. More information is expected today after a visit by journalists. Meanwhile, President Biden says the U.S. will give Ukraine as much as $600 million in additional weapons and ammunition. The aid will come from existing stockpiles. A retired federal court judge has been named as special master to review all 11,000 documents seized at Donald Trump's Florida home. The special master has until November 30th to complete the review. Meanwhile, the judge in the case has refused a government request to use documents with classified markings in a criminal investigation. Shares of Uber are lower today. The ride-hailing company has shut down internal Slack messaging while it investigates a cybersecurity breach. A hacker claims to have accessed sensitive company data. The number of inbound containers arriving at the busiest U.S. port fell by the most since the early days of the pandemic. Officials at the Port of Los Angeles say imports plunged 17% in August from the previous month, an early sign that consumer demand could be starting to moderate. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
A 1 percentage point rise in unemployment increases pain by 10 times more than a 1 percentage point rise in inflation. You shouldn't trust what the Fed says. They missed it last time. They said it was all about inflation last time, and it wasn't. And unemployment went to 10%.
Danny Blanchard, the former Bank of England Monetary Policy Committee member, and Danny highlighting a big problem. When unemployment starts climbing, how does this central bank convince the general public that that is a price worth paying to get inflation lower? From New York City, from London, for our audience worldwide, this is Bloomberg Surveillance, and here's the price action. We're down 0.8% on the S&P 500. Yields just a touch higher, but that story fades in the last hour. The 10-year back to 345. The 2-year had a little look through 390 and came back down again to 388.19. Yield still higher by a couple of basis points there. Euro dollar, Tom, negative 0.33%,
Yeah.
just a touch of dollar strength. 99.
We haven't even mentioned gold, 1,700 down to 1,665. I want to make clear, folks, the tape's better in the last hour, but this is one of, say, 5 of 200 days of the business year that are really extraordinary, and pay careful attention through the news flow into the weekend. Can you imagine another FedEx shock on a Friday?
How many more are we going to get? And
yeah.
that's kind of what we're grappling with, Tom.
Yeah.
Is this the beginning of something bigger?
Right now, and this is really important and exceptionally timely, I hate Ben Emmons. He writes beautiful notes. You have to read all of it. It's extremely smart with Medley Global Advisors. And he joins us here as a preview to Richard Clarida joining us on Wednesday for our Fed show, the former vice chairman of the Fed. Ben, you know Richard Clarida's history, up, down, and sideways. Obviously, he's a recent exit from the Fed. He will toe the line. But what would you want to listen for from Dr. Clarida about this Fed and this Fed meeting?
Hi, Tom. Yeah, what I would listen for is that has the tone of the Fed really changed from what we say at Medley is a bullish, hawkish Fed. Bullish on the economy, hawkish on inflation. And is that through that press conference really changing? Because as you've been analyzing the entire morning, rates are getting pretty restrictive here, whether it's mortgage rates or treasury yields. And you do reach a level at some point that there is a breakage, if it isn't already happening, as the FedEx numbers show. So right. I think you want to know about bullish, hawkish, because price stability matters more than the risk of unemployment at this point. As Chris Waller said a week ago, there's no trade-off for the Fed at this moment between employment and inflation, which emboldens them to go further.
Help us with a guess in the press conference of how Chairman Powell will identify a new x-axis. How far out are we going to go in time as we readjust on Wednesday?
Yeah, I do think they will project out in 2023-24 what they think the terminal rate ultimately will be. And I think that's key for markets to understand. You know, we're calibrating at the moment. Could it be 4.5? Could it be 5? To your colleague Anna Wong, it could be even higher. So that's one thing. The other thing, of course, is that the staff economic projections will skew more towards downside for growth and inflation over time. And is that into the recession territory already or not? So I think those are the edges, Tom, as we enter that meeting and post that meeting, which I think Rich will very much highlight. Like, yes, despite that recession risk in the horizon, this is an emboldened Fed that wants to continue.
Ben, it seems like the asymmetry of risks for the Fed has put inflation at the forefront. The asymmetry of risk is that inflation becomes unmoored and undermines their credibility. Do you think, though, it's gotten more balanced, that the fear that they go too far is now more relevant, especially as the likes of the World Bank says, rates where they are, rates heading as high as they could, the dollar moving as strong as it is going to torpedo the global economy?
Yeah, I think that inflation expectations are moving in the right direction. You know, the New York Fed survey was encouraging, whereby you will have to take note that they also published the inflation uncertainty component too, which is still really high. So we're moving down to the average. And as Powell said, as long as these short-term expectations are moving down, then long-term expectations can stay anchored. Because if they're not, those short-term expectations, then they do have a credibility problem. So it seems to be moving the right direction, but it's not entirely there yet. So it requires this additional 75, 100, 200 basis points of rate hikes to get the short-term expectations more anchored at 2%.
Do you buy the argument, Ben, that right now this economy is less interest rate sensitive than many people had imagined, even though there is so much more debt than there was the last time that we saw rates at these levels?
No, I don't, because, you know, as you can tell from the housing market, it's clearly where Fed policy is showing up in full force already. We do have to indeed think of debt outstanding. It's substantially larger, so there is this risk of deleveraging if you raise rates to a level that's so restrictive that you're getting a turn of deleveraging by corporations and by households. So no, it's a highly sensitive, highly interest rate sensitive economy.
Ben Emmons of Medley Global Advisors, thank you, sir.
Thank you.
Both bullish and hawkish. And Lisa, I think we started the programme this morning with that very story. Are they being emboldened by a lagging indicator? They're bullish to the economy, but ultimately what's inspiring them is a tight labour market and claims back to, what was it yesterday, 213?
Exactly, this idea that there still is resilience, and people question for how long. But I want to just point out something. We had expected quantitative tightening to really accelerate, right, this particular week?
Yeah.
The Fed's balance sheet rose. The amount of assets actually rose.
Would you like to explain to everyone what you do at Thursday at 4:30 Eastern Time?
$8.3 trillion, but I mean, this is crazy.
Sure.
Yeah.
And it's meant to be coming in and tightening.
And it went up. I'm just saying.
What are you doing? It's very distracting.
I'm here with Scott Cronert. I mean, come on. Can I get out front on this? Well, you guys are you're gallivanting around.
What, with delivery?
Yeah, exactly.
Okay.
Everybody's starting to publish in this maelstrom. Scott Cronert at Citigroup just puts out a piercing note and says it's time to underweight financials.
Yeah.
This is what we're going to see, folks, this weekend. We're having fun in London in the somber moment here with the Queen, and we'll have our funeral coverage on Monday with all the world leaders getting together. Global Wall Street is writing and thinking as hard as they can.
Adjusting, and Tom, I'm pleased you brought it up because that was the consensus position in this equity market at the start of the year, was to get long banks because the Fed was going to go on a rate hiking cycle. And here we are with a rate hiking cycle that the consensus didn't foresee at all, because we were talking about 1%, maybe 2% this year. Now we're talking about 3, pushing 4, maybe even 5 into next year.
You're looking at a yield curve that's incredibly inverted. You're looking at deal activity that's fallen off a cliff. You're looking at this concern that FedEx expressed that companies are not going to be spending as much. It is not a recipe for banks to do well.
I can tell you things are turning just a little bit. We were much, much lower this morning on the equity market. We're now down just 0.8%. Yields were a lot higher. The 10-year just rolling over in the last 20 minutes or so, Tom. Now basically unchanged at 344. 56.
We pause here now for a momentous moment where someone came up to me and thanked me for my soccer knowledge and coverage here in London.
Did that actually happen?
The olive came out of the martini. Let's do this right now. This guy's exciting. For those of you that don't follow this is a reason to follow John Ferro in English football. This kid at Man City.
No idea.
John, this kid at Man City, to me, is the day Shaquille O'Neal showed up in the NBA.
Erling Haaland, absolutely prolific. He's an old-school goal scorer.
6'10"?
I don't think he's quite 7 foot, but he's an old-school goal scorer. Number 9. We kind of drifted away from that in the last decade or so. Manchester City going back to that. A poacher, Tom, someone who likes to play inside the area but can break from the back as well. He's just awesome.
Did someone actually come up to you and thank you for your soccer?
Oh, yeah.
Happens all the time. Happens all the time.
That's wonderful. That's beautiful.
He said the two of you are
Then he woke up and stormed out of
He said the two of you are gaslighting me the entire trip. You're gaslighting me.
Watch it.
The U.S. inflation number was horrific.
The valuation story still suggests that there is more downside unless the retreat in inflation happens much more quickly.
The worst outcome, I believe, it would be if we see inflation remain elevated to the medium to long term.
If you had any hope that Chinese demand was going to help the growth story right now, you can forget about that.
If we stop the tightening of interest rates, I think the market would probably come out of that okay.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
RV guidance cuts just getting started. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down 0.8%. At the epicenter of this move this morning, a little bit earlier, yields higher. That fades. TK, FedEx, front and center.
FedEx down 20%, really a bellwether here. And for those international, it's a hugely important stock that America follows. Global Wall Street in America follows every step of the way. John, what I would notice today with NASDAQ down a full 1%, trend continues, and you wonder where we are at 2 p.m., 3 p.m. this afternoon in New York. How do you stay long into this weekend?
FedEx down 20% in the pre-market. That's just a wow move for a lot of people. And Bramo, we asked the question, let's do it again. Is this the beginning of a sequence of events like this one that we'll see deeper into the year?
It's the pace of which they saw the change in the outlook. And I think you pointed this out earlier, which was really a good point. The speed, and the speed of which we're actually repricing some of the hawkishness of the Fed at the same time that companies might be rethinking how robust the economy is, really is a toxic recipe, and brings up Mike Wilson. The bulls, though, see the idea of, okay, that weakness will let the Fed take their foot off the gas. Is that really possible?
You almost laughed then, didn't you? The toxic brew. Throw in high yields as well.
Laugh. I don't laugh.
Jim Paulson in the opening. John, importantly, Jim Paulson in the opening and others pushing. Michelle Meyer, I thought, was optimistic at MasterCard. They're pushing against some of this toxic brew.
They're asking the question as to whether this Fed can keep on hiking in the way it is, the way that people are expecting them to. And to really frame that, and we've mentioned it a few times, we should do it again. Matt Lazzetti at Deutsche Bank, if you're just tuning in, he's now looking for something close to 5%. I think it was 4.9 on Fed funds.
He's catching up with Anna Wong of Bloomberg.
The amount of doubt out there, Tom, on this Fed's ability to actually get there, Lisa, that's where the debate is. Can we live in a 5% Fed funds world?
And there's also this concern about a lack of understanding of the lag time that these rate hikes will take to actually hit the economy. Because if we don't know what the actual effect is, and the Fed keeps hiking, is there suddenly a 1-2 punch where people actually see the weakness and you see the ramifications of those higher policies all at once?
And yet they're emboldened by a lagging indicator on top of that as well, the labour market. I mean, Tom, this raises the question, and Mark Urbana said it earlier this week on this programme from Bank of America, the Fed getting lulled into overdoing it. How many times have we heard that?
It's an interest rate financialization analysis. When does the Fed look at the real economy? That's the heart of the matter.
6% mortgage rates. Are we there now?
I think 6.2%. 30-year, could you imagine 6.5% based on the trend we're at?
But if we don't get prices to come down a little bit for houses, then the affordability crisis gets even worse also. On the margins, they're starting to, but the goal isn't this the point, that they want to bring the froth off this market because it had gotten too hot?
Let's digress quickly here because we've got an important guest. Sterling goes to 110. All of America buys Knightsbridge, except everybody's demand there. How do prices go down in Knightsbridge? they don't.
Well, that's everyone else's problem, isn't it? It's our currency, your problem. And that's maybe what the Fed is communicating right now. I think that was absolutely tremendous. I think the big conversation we're ultimately having, whether it's FedEx, whether it's the labour market, mortgages, house prices, all of the above, what price do we have to pay for this Federal Reserve to get inflation lower? And I still don't think we fully realise the price we have to pay for that. They've got these kind of optimistic, aspirational forecasts of unemployment slowly creeping higher into the high 3s and maybe breaching 4. Are we going to be talking about something close to 5%? And really, that's what Matt Lazzetti and co. are thinking about.
We just don't know. And a lot of this has to do about whether some of these factors cooperate, and the CPI report did not cooperate, and now we have a 2-year yield bumping up against the 4% level.
Equities right now down 0.9% on the S&P 500. Alongside us, I'm pleased to say, Dan Morris is going to join us, the BNP Paribas Asset Management Chief Market Strategist. Down that equity market, down about 37. Let's start here where we started with many people this morning. When do you buy this? When do you feel confident about buying this?
Well, we need to see the second shoe dropping. The one we've had so far is the correction of valuations because of policy rates going up, real rates going up, PEs on the NASDAQ going from 33 to 20. So all well and good because we need to get to a reasonable level. But we know by looking at consensus earnings estimates, those haven't adjusted yet. And if we talk about this recession scenario for next year, that's not particularly compatible with the 8-9% year-on-year earnings growth forecast that you see in the consensus.
Yesterday or the day before, just for a whisper, I got the feel of the 70s. I was a bit younger there. Bob Seger was killing it. Okay, great. You write about it in your research note. You say the wage price spiral is here.
Yeah.
Identify that.
Well, the headlines yesterday were, strike averted with the railroad workers in the U.S., which, of course, very good news, but it was worth noting that part of that deal, assuming it's approved, was a 14.1% increase in wages now. And of course, we've only had 8% year-on-year inflation, so they're making up, so all well and good. But if you're that railroad worker, and good for them, they'll have the salary, but what are you going to do? Well, you're going to spend it, so that's going to push up demand, that's going to push up inflation, and off we go. So, you don't see the same level of unionization across the economy, so it's nice to suggest this is going to happen broadly, but it does highlight the challenge the Fed faces in trying to stop exactly that process.
So do you disagree with Subhadra Rajappa of Societe Generale when she said that perhaps the market has gotten a little ahead of itself and the Fed is going to have to push back on how aggressive people are pricing the Fed funds rate?
Oh, gosh. The market is now ahead of where the Fed was at the last dot plot, but it's kind of closer to where we expected. We always expected it to be between, say, 4 and 4.25, and we're there now. So that's kind of the good news when we think about the threat to equities from the increase in policy rate expectations. We've gotten above 4. We're in kind of the right general area. But now this debate is how long does it stay there? And the market still has the Fed pivoting spring of next year, the Fed saying no, maybe spring of the following year. Again, that's more what we think is going to happen. So there's still that adjustment that has to take place, and we've seen those aren't particularly pleasant.
Pretty scary world right now. Easily to scare yourself even more if you wanted to. Tom's asked the right question, I think, all week. Where do we hide? Where do you hide?
Well, I think we need to think about time frame. So what we've seen so far this year is the dollar's been the one safe haven. And if you look at the supports that you've had for the dollar, they're probably still in place now. Does the dollar continue to appreciate? Not necessarily, but it's reasonable, I think, to see it staying there. If there is good news in this, you're nearly 3.5% on treasuries. And for us, we don't see a big increase from here. So you're at a level on treasuries where if yields are stable, you're getting 3.5% there. Even if equities are weak, at least we're going back to a negative correlation in the price returns for equities and fixed income. And that'd make a lot of multi-asset portfolio managers feel a lot more comfortable.
BNP Paribas really thought about this. You've got yourself, Carl Riccadonna over in America, and others really thinking hard about this. Taleb yesterday, Nassim Taleb, who I adore, out on Twitter saying we've been doing the math like we don't have gravity in physics. We're getting the gravity back, maybe we're getting the risk-free rate back, and the Sharpe ratio, does that clear out the zombie companies, the zombie banks, the zombie manufacturing shops, and the others?
What makes it difficult to assess, and this is kind of one of the implications or the consequences of the pandemic. So what we saw with the lockdowns was the response of governments was like nothing we've never seen before. And we're starting to see hints of that, at least in Europe now, with the energy crisis. Governments willing to do much, much more than they would have done in the past. So what that might mean for balance sheets, for longevity of companies that otherwise maybe would have gone bankrupt, I think that's an open question. But then we have to think, well, if they're doing this, where's that money coming from? And we're going to start looking, again, I think, much more at government balance sheets, debt levels, if it's not going on the corporate side.
We start to treat G10 countries like EMs. Is that what you're trying to say, but not saying?
I
Are you getting close? Are you getting closer to saying that?
We're going to. Well, you already see it in
Shall I say
EM
it
now.
for you?
You know, current account deficits. Current account deficits in EM are driving the currencies there. So you know, it is going to become a bigger consideration, a larger consideration in the future.
For the UK right now, or in the future?
Well.
Feels like
you
right
define
now
the
to
future
me.
Tomorrow.
Feels like right now to me. Dan Morris there, of BNP Paribas Asset Management. Very diplomatic, Dan. I won't be. Feels like we're there right now, Tom. Feels like we're there right now.
The analysis suggests that we're not there, but we're tending there rapidly. The analysis of the optionality of institutions is narrowing fast.
Lisa?
I just can't get over that Tom loves Nassim Taleb, and then he calls me the Uber bear.
Oh, well,
I mean, you know, you're the triple leverage all
Nassim and I go way
cash.
back.
I'm not offering therapy here.
Yeah.
You know, you can speak past me. Is something you want to say?
No, honestly, I think that you're going to see a lot more volatility in the FX channels because that is where some of the difference in economic growth trajectories will be expressed. How violent do things get if Japan really, to me, that's the wild card,
Well,
if they are forced to abandon that peg.
To your point, into the weekend and Sunday night in New York, opening in Asia, Japan's front and center.
I would agree.
I mean, I wonder what the Monday is going to look like in Japan.
You're agreeing with each other now.
You did a great job being a therapist.
Can I say that somebody emailed in and they said,
lean back a little.
They said, we don't have Tang in London. And I said, but you've got Tang Pico tea.
Okay.
And it's really good.
So what is this?
This is Tang Pico tea.
And what does that taste like? What's the review?
It's really sort of tepid. I just,
Okay.
I'm on the edge of Ted Lasso.
Have you got a commercial agreement with them yet?
No, I don't.
Okay.
But it's just brown. And,
you should negotiate that. It's brown.
It's Tang Pico
it's
tea.
tea.
It's like orange Pico, but it's Tang
It's
Pico.
like orange flavoured tea.
Yeah.
Okay, I'm pleased we cleared that up. Everyone was wondering what you're drinking.
Yeah.
Which is usually the case. Futures up 9/10 on the S&P 500. Yields unchanged on a 10-year.
This is an important conversation
3.45.
coming up.
I couldn't agree more, Tom. We're going to catch up
normal.
with Jose Antonio Ocampo, the Colombia finance minister. We'll do that very shortly. With futures down 0.9% on the S&P, and a big warning from FedEx that maybe some guidance cuts are in our future across a range of companies. FedEx in the pre-market is down about 20%. Live from London, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The pound has fallen to its lowest level since 1985. Sterling dropped by as much as 1% to less than $1.14. The latest hit to the currency was data showing British retail sales fell at their sharpest pace in 8 months in August. Since the start of the year, the pound is down about 16% against the dollar. In Germany, the government has begun what may be a series of historic takeovers to try to avert a collapse of the energy industry. Regulators are taking control of Russian oil major Rosneft's German oil refineries. Now, Germany is also nearing a decision to take over Uniper and 2 other large gas importers. China has imposed sanctions on 2 American business executives over the sale of anti-ship and air-to-air missiles to Taiwan. The penalties were being levied on Boeing Defense CEO Ted Colbert and Raytheon CEO Gregory Hayes. Now, the missiles were part of a $1.1 billion U.S. arms sale to Taiwan announced earlier this month. More than 100,000 workers will decide whether there's a new labor agreement with U.S. railroads or a strike. They will vote on the tentative deal reached on Thursday. Now, the agreement increases wages and includes a compromise on sick days. A timetable for the voting hasn't been released. And it's a potentially worrying sign for the global economy. FedEx has withdrawn its earnings forecast due to worsening business conditions. The package delivery giant pointed to weakness in Asia and challenges in Europe. FedEx is taking immediate steps to cut costs, including parking some aircrafts, cutting workers' hours, and closing more than 90 FedEx office locations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
on Kate, well, our target now is 109. People are out there talking about parity. Can we dismiss that? No, I don't think we can dismiss it. It's not our target, but, it depends very much on the US dollar. So, these are still nasty numbers to come. And right now, I think the dollar strength will sustain.
The fact that Jane Foley of Rabobank can't dismiss the prospect of sterling hitting parity tells you a lot about this moment we're in right now with dollar strength. That was Jane Foley of Rabobank just moments ago. Live from London, this is Bloomberg, and here's the price action. We're down about 1% on the S&P 500. Yields were much higher, they fade. Unchanged on a 10-year, 345.53. The dollar stronger. Euro dollar negative 0.4%, 99.61 on euro dollar. I'm going to keep promoting this. Next week, Fed Decides Day. The show's coming together. We'll catch up with Matt Lazzetti of Deutsche Bank. He's looking for 5% Fed funds, something close to that next year. We'll also catch up with Rich Clarida, the former Vice Chair, Tom. And we've got to work out. At the moment, it's our currency, your problem. When does it become our problem?
Exactly. And the historic scale of that is something that Dr. Clarida has worked on as the former Dean of Economics at Columbia University, always affiliated with Columbia University, out of Notre Dame, and of course, most importantly, out of Yale University. Jose Antonio Ocampo joins us now, Minister of Finance and Public Credit for his Columbia. We're thrilled that he could join us this morning. There's so much to talk about, Minister, but I have to go larger. I have to reach back to Stan Fisher in 1998. Do you, through the prism of Columbia economics and foreign exchange, see anything like an international upset that we witnessed in 1998 and, frankly, before that in 1992?
Well, thank you. I'm delighted to be with you. Let me say on that I don't think the same kind of crisis, the 1998, was very much an emerging market crisis. This is a global crisis, both the slowdown, particularly the inflation, and the increase in the interest rate, which is affecting us very heavily.
And very importantly, sir, I look at the caps, the limitation of price increase. We see it on India and their challenges with rice. Here in the United Kingdom, we see it. And indeed, Colombia and others talk about it. Given a more global economy, the speed of information, the transfer of finance, can caps be effective in 2023?
Well, let me say that the major problem that we're getting from the global economy is the inflation, but particularly the effect it has had on interest rates. So both domestic interest rates in Colombia, as well as the interest rate in global capital markets are very high, and that the major specific effect. Of course, inflation is hard to fight due to the international dimensions of inflation. So for a specific country, it is very tough to fight that inflation, which you can say is a supply inflation rather than demand inflation. Central banks are good at managing demand inflation, but less so in managing supply inflation.
There's a great concern that when the Fed hikes rates by as much as the market is currently pricing in, Minister, that it will create some real problems for the rest of the world. And I wonder, from your Colombia, whether you're taking a look at the dollar market and saying we cannot raise money in that right now at affordable rates. Is that really the situation as you look at your financing needs looking out?
Yes, private capital markets are very expensive for emerging economies today. Including, of course, Colombia. So for the time being, our international financing is coming from multilateral development banks and official institutions. But so far, we have not gone this year into the private capital markets. We hope things normalize somewhat in the near future, and we'll go back to the market. We're expecting to raise about $1.5 billion in the private capital markets next year.
What does it mean for things to stabilize, Minister? Does it mean that the dollar stabilizes? Does it mean that the Fed stops raising rates? Does it mean that inflation stops accelerating?
Well, it really means that the long-term interest rates of the U.S. start to fall. They were falling actually before the recent announcement of the Fed that they would likely increase interest rates again in the next meeting. But before that, they were falling, and also the risk margins for emerging markets were also falling. But the situation has changed again. But we hope at one point when the inflation stabilizes in the United States, the interest rates of the U.S., particularly long-term interest rates, which are the relevant for us, start to fall.
Dr. Ocampo, you have been one of the great voices of Colombia through a time, and the stereotype in America is of true civil unrest in Colombia. You've moved beyond that with a new government and your participation as well. Can you describe the stability in Colombia and what it means for your tourism? So many people have gone to Cartagena and the rest of it. Describe the tourism future for Colombia after decades of real unrest.
Well, let me say that the peace process that took place 5 years ago has been fairly successful in generating peace in several parts of the country. The current government is involved in other negotiations that we hope will be successful, and let's say the return to peace in many parts of the country has generated effectively what you say, actually a boom of tourism. We hope that it will come back when the world economy fully recovers, because tourism in the world is still a bit depressed, let's say, although it's recovering. And in Colombia, we'll hope to have a new boom of tourism.
Minister, we appreciate your time today. It's lucky to catch up with you. We're lucky to catch up with you. Jose Antonio Ocampo there. Minister, talking to some of the problems we've got in the world right now. You forget that in EM, they've done a lot of work already on the rate side before the Fed even got started.
Yeah, their rates up in the 8-9% level, raising rates to offset some of the impact from those higher dollar costs. I was really struck by the fact that he said he's going to rely on some of the international agencies for financing rather than tapping the dollar market right now because things are just too expensive.
I know Damian Sassar and his team are working 24/7 on this. Damian does this better than anybody out there, linking foreign exchange into the bond dynamics of emerging markets. But it drives forward, as Lisa mentions, John, this is not a normal IMF meeting coming up here in 4, 5, 6 weeks. I can't even tell you what it's going to be, but it's going to be important conversations for our international audience.
I can tell you we might be there.
We might be there.
We might be there.
If we ever get home.
Coming together. Seth Carpenter
it's awfully nice here.
might be there from Morgan Stanley too. Are you thinking about staying?
Well,
you're considering staying
this weekend.
Okay. Bramo is converted. She's thinking about staying. New York for life, and now she's all like super hyped up on London.
I saw in Fortnum and Mason.
Seriously, loves it. Future's positive, now negative 1%. Bramo sent them there. This is Bloomberg. Our next guest sees a 75 basis point rate hike from the Fed next week, sees Fed funds peaking just above 4% in the next year, and then rate cuts in 2024. We're going to get to that in just a moment. Equity futures take another leg lower. We're down by a little more than 1 full percentage point on the S&P 500. This happens as the 10-year rolls over. It's not higher. It's basically unchanged on a 10-year, 344.56. Dollar stronger. Euro dollar negative 0.4%, 99.62. That dollar strength, Tom, that is sticking through much of this morning.
An important conversation now, and this gets us in preparation for Richard Clarida joining us on Fed Day as well. Clarida is known for DSGE, and all we're going to say is it is dynamic. And as Meghnad Desai, joining us in Delhi the other day on the Queen, stated general equilibrium theory. And in the middle of all that is stochastic. And what that means is things are moving rapidly. And Seth Carpenter is chief global economist at Morgan Stanley and knows decidedly it is a stochastic 2022. Seth, what is the process or path to get to calmer times, a calmer economy, and calmer markets?
Well, I think that prospect will require a fair amount of luck. I think the challenge here, especially you started off talking about the Fed, they are feeling their way to how far they have to raise the federal funds rate. They want to be restrictive. They want aggregate demand to slow down a lot so that that underlying inflationary pressure starts to ebb. But what they don't want to do is intentionally cause a recession. And getting to that point, I think, will require a bit of luck.
How do you respond to the idea that the inflation impulse has a certain effect on the public, but the jobless impulse has a much greater effect?
Oh, I think they're both very, very important. Clearly, for people who have lost their jobs, that's just very, very difficult. It crimps their spending a great deal. We don't have in our forecast any meaningful rise in layoffs. In fact, if you look at the last jobs report, that was super strong at over 300,000. So far, that's been okay. The inflationary side of things, though, very much hits the pocketbooks of everyday people. The rise in gas prices that we saw a few months ago was painful. That's starting to come off now. I think the challenge for the Fed then will be, if gas prices come down, do people go back to spending more, or have they been hit hard enough in the pocketbook?
Seth, we spent the whole of summer trying to work out what the threshold would be for a pivot, a pause, maybe even rate cuts next year. You've got rate cuts out in 2024. I just wonder, what is it about 2024 where you think this threshold is going to be breached and the Fed starts cutting?
So I will just own up front, the uncertainty here is huge. We said for many, many years, lower for longer was what central banks are doing. Now it is higher for longer. And again, I think what the Fed is trying to do is feel their way to where they can rein in the economy without actually causing an outright recession. And that's the reason why they go to what they call restrictive territory, but then not so much that things actually crash, and then hang out there as the economy slows down. So that's what we have as our baseline, is you're getting some traction, and then they just wait for things to slow down.
Right. John, I just want to point out, equity futures just moved to new lows for the morning.
Another leg lower.
Yeah, another leg lower.
That's the story so far, Seth, and the story many people are grappling with for participants in markets at the moment is whether these are sufficiently tight financial conditions for this Fed to achieve its objective. Do you think they are right now sufficiently tight?
Very hard to say. I will say one of the most typically sensitive sectors is housing, and we have seen a very strong rollover there in housing. On the other hand, consumer durable goods spending is actually still holding up to some degree, so it's not clear that things have actually bitten yet. That said, you were talking about equities. My colleague Mike Wilson always points out that there's probably needs to be a leg lower in earnings projections, and I think that makes sense. If the economy is going to slow down enough to get inflationary pressures under control, you just have to expect earnings across the board to be lower than they are now, and we're just not there yet.
I like your call for holding it at 4%, though, for almost a year for the Fed funds rate. And I wonder if people are underestimating the pain of holding rates at a level like that rather than just missing the boat, raising too far and then quickly cutting again, which seems to be the projection in markets.
I think there probably is a bit of underestimation there, but I suspect the even greater underestimation is what happens if hiking rates to 4% isn't enough? What happens if they hike to 4%, wait there for a quarter or two, and the economy just proves to be strong enough that demand is there and inflation doesn't come down? Then the Fed's just going to keep hiking. And I think that point, that there's not really an upside to economic growth right now. It is either things slow down and inflation comes under control, or they don't slow down and the Fed just hikes more until they do slow down.
John and Tom both make fun of me because at 4:30 p.m. on Thursdays, I take a look at the Fed's balance sheet to see where it is and whether it's coming down as they promise quantitative tightening. Over the past week, it actually rose. It became bigger, even though they ostensibly were supposed to be accelerating quantitative tightening. When do we start to feel the effects of this? When does it start to matter for markets?
It's a great question, and you and I can sort of bond on Thursday afternoons. That was a big part of my job at the Fed, was being in charge of the H401 statistical release. Nerd alert. The challenge, I think, with getting QT to actually show up on the balance sheet in large part is, some of the way they're settling their mortgage-backed securities holdings on a forward basis, and so it really hasn't shown up. Just give it a couple more months. The treasuries are coming off their balance sheet. Over time, the mortgage-backed securities will prepay and go away, but it does take a long time.
Seth, I look at ADXY as a bundled Pacific Rim thermometer, if you would. I look at Korean won unraveling through the week. Help us into the weekend and into the Asia morning. What is the gamesmanship Morgan Stanley sees? You've got Robbie Feldman in Tokyo, who's iconic, but what is the gamesmanship you see of the Bank of Japan and the Ministry of Finance into their Monday morning, our Sunday evening? Are we close to action?
That is a great question. So our baseline view is no, not from the Bank of Japan. You have Governor Kuroda in place. His term is up in the first half of next year. He has been committed for so long to being easy with policy to try to get inflation up. Now it is working. Clearly, the yen has gone on a tear, going lower and lower and lower against the dollar. But finally, they're starting to get some traction with inflation.
Seth, very importantly, what do you read and listen to from Robbie Feldman? You have the advantage of Dr. Feldman in Tokyo, who's absolutely iconic on this. What is Robbie's twist on this?
No, Robbie is fantastic, and I think everybody should get the opportunity to read his work. I think the key really is here all about legacy and the amount of time and effort that has been put into this very easy policy to try to get inflation up. Japan has had lost decades, plural now, when it comes to the deflationary spiral, and I think there really is a sense, at least with Governor Kuroda, that it's critical to stay the course to get inflation up.
Seth, can we just wrap things up with FedEx? It's such a big story for everyone this morning. It's arguably contributing to some of the nervousness around the equity market as well. The stock's down almost 21% in the pre-market. We all know this is not a small company. It was something like a $50, $60 billion company. It won't be if we close here a little bit later. Seth, they're talking about speed, that things have slowed down really, really quickly. Is there anything that you look at on your dashboard that would perhaps resonate with what FedEx are experiencing? Can you see anything like this?
Well, I think one of the key points with companies like FedEx in the shipping business is we did see this massive surge in goods spending. Yesterday's retail sales report didn't really make you feel like it has unwound completely yet, but it does seem that at some point we're going to have to see that consumer pull back from as much consumer spending as had been going on physical goods. And that's going to have ripple effects across the economy to retailers, but also to companies that do a lot of shipping.
Seth Carpenter of Morgan Stanley. Seth, thank you, sir.
Thank you, Seth.
It's good to hear from you.
Thank you.
And it speaks, as Seth said, to Mike Wilson's world, and we've mentioned that a few times. Mike Wilson over at Morgan Stanley was looking for that next so-called shoe to drop. Earnings warnings, those kind of things. To see FedEx down 20% and warning about a rapid change in the business environment, can you see any other data point out there? Maybe the regional Fed PMIs that back some of this up, the regional Fed indicators?
It's been messy, though, right? It's been inconsistent. And it goes to this question that we just heard from Seth Carpenter, where if you start to get gasoline prices that are becoming lower, what happens to consumer spending? Do people keep spending more in other areas? Do they feel lighter, or do they just continue to get a little bit more cautious? And I think that we're not getting a clear sense of that from companies yet either.
A guy talked about how global some of this was as well, Tom. Is that enough to spook you, that FedEx move, 20%?
Oh, yeah. I think you can link a domestic image like FedEx right into the global view. We feel it here certainly in London as well. But I, again, would go to Asia with lockdown. I mean, I believe we can state as a general statement.
Yeah, I think so.
They're still in lockdown, and I'm fascinated to see how the IMF readjusts Asia at their October meetings with the World Economic Outlook. Are they in negative GDP? That would be just a stunning outcome.
Can you think of a two-handle maybe on Chinese GDP growth from that organisation?
I'm not qualified to make that decision other than the vectors. Lisa is.
Yeah, well, and there is a question of whether people want to be the ones out front with that, just based on some of the climate. We got some data from China overnight,
Wasn't bad.
It was better than expected. What I thought was interesting was that the Chinese yuan did not strengthen versus the dollar. Quite the opposite. It continued to weaken even though we saw better than expected data. So either people aren't buying it or it isn't enough to really make people feel optimistic about growth.
And dollar China still a 7-handle. Yeah. Coming up in the next hour, Lindsay Piegza of Stifel on the outlook for this Fed. We're only a week away, not even now. Greg Staples of DWS. We're going to talk about the bond market with him. Have we finally seen the highs of the year in this bond market in yield terms, 2s out to 10s? And James Athey of Aberdeen. James has got some things to say about Europe, I know, and on risk assets more generally, and he's perhaps in your camp, Lisa, more than Marko Kolanovic is over at JP Morgan.
The too polarized.
Possibly.
We'll hear from Mr. Athey a little bit later. Looking forward to it. Live from London, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A retired federal court judge has been named as special master to review all 11,000 documents seized at Donald Trump's Florida home. The special master has until November 30th to complete the review. Meanwhile, the judge in the case has refused a government request to use documents with classified markings in a criminal investigation. The White House is offering state and local governments $1 billion over 4 years to fight cybercrime. It's part of an effort to beat back attacks from criminals who have targeted everything from gas pipelines to meat factories. The money comes from an infrastructure bill that was passed last year. Meanwhile, shares of Uber, they are lower today. The ride-hailing company has shut down internal Slack messaging while it investigates a cybersecurity breach. A hacker claims to have accessed sensitive company data. In Ukraine, President Volodymyr Zelensky says a mass grave has been found in a city that Russian troops abandoned last week. More information is expected today after a visit by journalists. Meanwhile, President Biden says the U.S. will give Ukraine as much as $600 million in additional weapons and ammunition. The aid will come from existing stockpiles. And as more companies make the return to office push, many employees feel they have no choice. According to a survey from productivity software company O/, almost 80% of remote workers think they would be fired if they said no. Nearly 60% of employers say they'd be okay with them resigning instead of returning to the office. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The major problem that we're getting from the global economy is the inflation, but particularly the effect it has had on interest rates. It is very tough to fight that inflation, which you can say is a supply inflation rather than demand inflation. Central banks are good at managing demand inflation, but less so in managing supply inflation.
Jose Antonio Ocampo, the Minister of Finance and Public Credit for Colombia. Fantastic to catch up with him maybe about 30 minutes ago.
It is. And Joe, what's important here is he said it's not 1998. There's a lot of fear out there about the X crisis that as you mentioned this earlier this week, you can get a whisper of what happened in the past, but this is new, and the new part of it to me is coming off the pandemic. No one really expected this.
Struggling with these chairs. Need to shift over to Bramo just a little bit. Just turned away from her. You good?
I'm good.
We're
Are you good?
Okay.
Great.
We're good. I can check it on the market now. Down about 1%. All is right in the world. On the S&P 500 for the leases of this world, we're down by 1.2% on the S&P. Come on. I know. I'm just joking. Okay, it's a joke. All right.
Don't make me.
We're traveling together. We're sharing a plane. It's going to be beautiful. All right. Yields up. A couple of basis points on a 10-year, 346.50. Equities a leg lower, Tom. I think it's fair to say. In the last 30 minutes, we're down 1.2% on the S&P. Yields a bit higher by a couple of basis points on 10s. Not a million miles away from 350 at 346.50.
We're going to get you into the market open in the next hour, and we're thrilled to be here with this last hour of the week in London. I will be here Monday for the funeral. That will be, of course, historic with the world leaders attending. Marcus Ashworth is noting that as well. He's Bloomberg opinion columnist and joins us here with a broader discussion of the moment we live in. Marcus, you and I have been through any number of crises like this. What is different this time besides that we're coming out of a pandemic?
Well, it's interesting. I was on radio earlier talking about 30-year anniversary of sterling falling out of the ERM, the exchange rate mechanism. This is a different crisis for sterling at the moment, that's for sure. But it's a wider global crisis caused, well, by the strength of the dollar, which is starting to cause real pain. Now, you were talking about FedEx earlier. That's right. a brief forecast of what's happening already hard in Europe and also in the UK. We have very bad retail sales data, a very volatile number, but the consumer has hit a brick wall hard in the UK, and we're probably therefore already in recession.
Right. Marcus, I want to channel Steve Rocha on this and his great work on asset dynamics away from monetary and fiscal policy. If we assume, unlike ERM 30 years ago, that we have a much more floating rate dynamic FX system and financial system, does that mean that given a crisis that we see more abrupt moves in asset prices?
Well, probably less, I would say. I mean, obviously going back to the Plaza Accord in 1985, and obviously the only real likelihood of currency intervention is going to happen in Japan. That's probably about the best news that sterling could have, because if anything can weaken the dollar, will benefit the euro, the yuan, the Korean won, pound sterling, the whole lot. You know, at the moment, it's just all about the dollar, and that makes it very hard. But it is least liquid, and it is at least liquid in the sense. What I worry about is with quantitative tightening, and also too much interest rate hikes from the Fed, we start having a problem with dollar liquidity. That's the thing that saved us through the pandemic, saved us through the global financial crisis when they were able to pour it in. So open and free exchange rates are a great thing. It's painful, but it's not sharp pain when things collapse, like for instance when the Swiss National Bank all of a sudden took their peg away from the euro. That was real pain.
Well, Marcus, to that point, and you mentioned that Japan might actually do intervention to try to strengthen the Japanese yen. What are the consequences for the bond market globally if they do that? It's not so much the yen, it's the JGBs that might sell off at a time when there isn't that much liquidity.
Well, I mean, the Bank of Japan's got a lovely control on two things. It's controlled, perhaps its interest rates and clearly its bond market. But it can't control the currency at the same time. So if it does come in and try and control the currency, it's going to have to sell U.S. reserves, e.g. U.S. Treasury bonds, which may make it a little harder for it, but the net effect for the bond market in the U.S. should be bad. Bear in mind that China and Japan have huge stores of U.S. Treasury bonds. If they start selling it for justifiable reasons to protect their currency, I'm talking Japan here, then that is going to have a knock-on effect also into the U.S. market as well. But clearly, I think currency intervention rarely works. The Japanese have had a very bad experience with it. They've learned really the only way to do it is when the tide turns back in their favor, then intervene and push that retreat much harder. But to try to draw a line in the sand and defend currencies, it really is a fool's game, I'm afraid.
What's your conviction level and the people who you talk to about peak yields on the longer end? We are hearing and seeing buying of the bonds when things start to get bad, but not necessarily with any real reliability. We are seeing yields once again tick upward for the 10-year. What's your sense of how close we are to peak longer-term yields?
Nowhere. I wish I could say with any conviction that anyone's saying this is. It's a great time to buy short end, maybe perhaps some of the better quality junk or low-end investment-grade credit, 2-3 year debt. That's great, but I wouldn't have touched long end at the moment with a podge pole. It is no sign it's hit a bottom yet. We could, and definitely I think we've got a chance we're going to go higher in yield. It may not last for long, but I don't have any conviction, nor anyone I speak to, that the bond market rout is necessarily close to being over.
And Marcus Ashworth, Marcus, thank you. It's the only thing I have conviction about, that no one has any conviction over anything right now, Lisa.
About Marcus,
isn't
or
that
just in
it?
general?
I mean, Marcus is not, and I agree with him. We've had a 15% move on the dollar index this year.
You know, you put it really well earlier when you're saying that there was this feeling long ago, people would say yields are going to rise, and then they got sucked back into the reality of the low yield vortex. Are we putting that on opposite now? Is that where we are with yields, with rates that are poised to rise and inflation that's the highest that it's been in decades?
We all remember it coming out of the financial crisis. It was forecast after forecast about higher rates next year, the year after, and it just never happened. It never materialized.
Well, and the inflation never materialized either, which is arguably why the Fed made the error that so many people thought that they made, where they waited too long, because inflation had already been deemed dead.
Conditioned by the previous regime and sowing the seeds for the mess we're in right now, I guess, to some extent. Trying to work out now whether we have fully capitulated, Tom, on this idea that we can't live in a 3-4% Fed funds world. I don't think we have, because the moment I put out that Matt Lazzetti call over at Deutsche Bank, they're looking for something close to 5. Tons of pushback. Can't live with 6% mortgage rates. Can't live with 5% Fed funds. That's the overwhelming consensus.
We had a conversation earlier this morning, and a thought went through my head, John. The idea, and this is out there, I think it'll be in the weekend literature. Where's the catharsis? And we're used to that. Where does VIX go 27 out to the fear of 32, 33? It just hasn't happened. Yes, we're down, but there's just a vector to it. There's just this impulse to it, unlike the down catharsis OMG feel.
Another leg lower. Right now, we're down about 1.3%, 1.26.
Like that professional analysis, OMG lower.
I love that.
Nailed it.
That was beautiful.
The OMG lower would actually maybe get a response. The fact that we're not getting it isn't getting a response.
I do agree with that.
It's just great to see you two agree with each other.
It's just
35 minutes out from the opening bell.
I'm going to swim the Thames this weekend.
Equities down 1.3%.
You got a pastry.
This is
Bloomberg. Have my floaties on.
This is an extended edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from London for our audience worldwide. Good morning, or good afternoon, good afternoon. This is Bloomberg Surveillance, and the countdown to the open kind of blended into one beautiful thing. With 30 minutes to go, equity futures heading lower and taking another leg lower in the last 30 minutes or so. We're down about 1% plus 1%, down 1.3% on the S&P 500. With Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures down 1.4% now on the S&P. I can't keep up, TK. On the NASDAQ, we're down by 1.43. Well, that's the point.
The deterioration in the last 90 minutes has been exceptional. You're looking at SPX 3800, which people have written about, and we're all going, yeah, right, while we're here. And also, like Dow 10,000, I'm sorry, a Dow 29,000 handle is a moment from Dow 36,000.
He's going to weave that in.
TK doesn't mention the Dow the whole of this morning, and then you wait until the 9 hour.
Well, wait, because we're going into the market hour now, and we know that America looks at the Dow as they look at the VIX.
Let's look at FedEx. FedEx in the
VIX, FedEx, I like it.
FedEx getting hammered, Bramo. What are we down by? 20% through most of this morning?
Yeah, and just staying there because of this warning, and we've been talking about it all morning. You pointed out how the velocity of change in their business outlook was what caused them to downgrade their guidance. And how much is this going to be a story for others as well?
It's a story for Mike McKee as well. Mike, we're all trying to get some kind of read on the U.S. economy. FedEx not getting a great read on the global economy right now. Your take?
Well, they are supposed to be some sort of proxy for the global economy because they move the stuff that makes up the global economy. And so here's the quote that scared the heck out of global Wall Street. Raj Subramaniam, the CEO, saying in their earnings report, global volumes declined as macroeconomic trends significantly worsened. A warning flag for the economy. It's already been picked up by economists. We have just now a whole series of Bloomberg surveys from around the world about the probability of recession. You take a look at what they're thinking for the UK and for the Eurozone, 60%. Generally, recessions follow when you go to about 30%. The US is at 50%. So there is a general feeling that a global recession seems to be coming. And we're seeing that reflected not just FedEx, but in a lot of other companies over the last couple of days. We've got General Electric, McDonald's, Alcoa, Nucor, the steel companies and metal companies really concerned about demand falling off as well. And we're finally seeing all of this reflected in earnings estimates from analysts, which had hung in there much higher than people anticipated. Even as the stock market's been falling, that is starting to roll over. It is becoming acceptable to think a recession is on its way.
Mike McKee, what is the history of how any central bank, and particularly the American central bank, reacts to this upset?
Well, the Fed in the past had reacted to markets, and that gave rise to the whole Fed put idea. But this year, they're trying to discourage that very strongly, telling the markets, we are not going to get involved unless there's a systemic problem. And right now, you're able to sell your stocks and get your cash without a problem. So the Fed is going to stay sidelined, and they're going to look at this as maybe the wealth effect falls a little bit, and that slows the economy.
Mike McKee. Thank you. On the latest, the wealth effect, this market's been hammered this year. Now we've got to think about house prices and what's going to happen to them with 6% mortgage rates, Bramo. 6%.
Yeah. This is the reason why people have been so surprised that the consumer has hung in there, right? You'd think with the wealth effect of stocks being lower, of housing prices going stagnating and possibly going lower as well, would make a difference.
We're lower right now on the equity market. We're down 1.4% on the S&P. About 25 minutes to go, 26 minutes to go until the opening bow. Joining us now is Lindsay Piegza, Chief Economist at Stifel. Lindsay, I'll start with Deutsche Bank's call. They're considering, in fact, calling for a 4.9%, 5% Fed funds rate next year. Do you think that's achievable?
Well, it's certainly not out of the realm of possibilities. It's going to depend on how inflation behaves. The Fed has been very clear that they will continue to raise rates regardless of the cost to the underlying economy in order to get the bedrock of the economy, price stability, reinstated. So should we see prices remain at these elevated levels or worse, push higher from here, I do think the Fed could be poised to raise rates significantly above earlier expectations.
Lindsay, I want to understand the FedEx syndrome, if we can call it that, a little bit better. They're warning about the global macroeconomic issues causing their business to see a sharp decline. How much is that going to be the theme for other U.S. companies, that the U.S. cannot escape the fate of the rest of the world? The rest of the world is deteriorating a lot faster, and there will be that rebound effect onto the balance sheet.
Well, we are a globally integrated economy. And so if we do see overseas demand, overseas production stalled, that's going to have not just an implication for economic activity here, but a significantly negative implication for economic activity here. We've already seen how supply chain disruptions can deteriorate production here at home. You compound that with a loss of overseas demand, and that will just snowball, have a snowball effect for U.S. businesses. But what we're seeing in the domestic economy is already a loss of domestic consumption. So it's not just about what's happening overseas. We have plenty of pain that's being felt right here at home.
We've been talking a lot about how the Fed is looking at lagging indicators to determine their policy. Do you think that the slowdown that we're seeing, that the impact that we're seeing, as you say, is sufficient to give the Fed confidence, to give people confidence that inflation is decelerating quickly enough, the Fed doesn't have to necessarily be as aggressive as they're currently making out?
I don't think we've seen enough evidence in the price data to suggest that inflation is coming down in a meaningful way. Now, I do think there's enough evidence on the consumer side, on the manufacturing side, on the broader-based growth side to suggest that the economy is slowing. But that's not going to be enough to ensure that price stability returns. Remember, we're dealing with both the demand and the supply side of inflation. So while the Fed raising borrowing costs will result in a tap down of investment, a tap down in demand, that can control the demand side of inflation. But raising borrowing costs will do nothing to alleviate the supply side inflationary pressures. So the Fed is going to err on the side of caution, waiting longer, raising rates higher than they normally would in other historical cycles because of that complicated composition of inflation.
Lindsay, if the markets deteriorate into this Friday afternoon and Monday and Tuesday, whatever comes, is it enough to change the Fed call on Wednesday?
If it's enough to change market expectations for the Fed move on Wednesday. So if investors begin to move back into a more benign 50 basis point camp, I do think the Fed could be willing to capitulate to market expectations. But right now, as it stands, the market is fully pricing in a 75 basis point increase. And in fact, some investors are still considering a larger 100 basis point increase. So at this point, I think 75 is baked in the cake.
Okay, fine. But are you suggesting that if we see this kind of market drop that we're seeing right now, that we could just automatically move a Fed to 50 beeps?
Absolutely. And we've seen this happen before. Prior to the July meeting, the June meeting, the Fed is watching what the market is anticipating, waiting for that green light for that larger 75 basis point increase. So if the green light is there, the Fed will move. Well, Lindsay, if investors start to get weary, I do think the Fed would slow that increase.
Lindsay, the broad yield curve, 230s, is back 22 years. Isn't that enough to suggest to them 50 and not 75?
Suggest to who? The market or the Fed? Because the Fed, again, is the Fed is focused on prices. The Fed is not focused on market metrics. The Fed has blinders on right now, and price stability, they said, is the primary focus. So as long as markets, despite the apparent inversion of the curve, the dysfunction is not there in terms of market activity, and that's not enough to derail the Fed's focus from ensuring price stability. Remember, we have inflation at a 4-decade high. And so even with that second derivative improvement, that price ascension slowing moderately for 2 consecutive months, that's not enough to reach that threshold that the Fed has said is needed to begin to pull back away from this more aggressive pathway.
And Tom, if they don't deliver what's priced, that's going to result in an easing of financial conditions.
Yeah, I guess, sure.
I don't think
I get it.
That's what they want right now, Lindsay, and that's the difficulty. And that's why some people still doubt their guidance, Lindsay, because they don't think they're going to say certain things out loud. For instance, really unveil what the threshold is for them to back away from interest rate hikes. Can you give us an idea on what you think that threshold is for them to take a pause?
I think we need to see a meaningful retreat. So we need to see headline inflation come back near this 6 to 7% range. I think that would be enough to suggest that we are seeing this retreat, that there's a downward momentum in prices, and that would be enough for the Fed to be willing to back off for more benignly sized rate increases. It wouldn't be enough to force the Fed to pause, but I do think that would be enough to get back into the range of a 25-50 basis point clip. But it's not until we get down nearer 4% that I think the Fed would be comfortable to pause rate increases at that point to allow inflation to continue to retreat further to that 2% preferred target range. So there's still quite a ways for the Fed to go.
We've got to run. It's great to catch up with you. Thank you, Lindsay. Lindsay Piesa there of Stifel. Your equity market right now, another leg lower in the last 30 minutes or so. We're down 1.4% on the S&P 500, a kick higher at the front end of the yield curve. Your 2-year, Lisa, is back through 390 this morning.
You know, what Lindsay was saying there, that right now they are not looking at what the market is doing. There is not market dysfunction that they have to keep track of, like that capitulation, Tom, that you were talking about. So what they are looking at squarely is the price action. It is not getting lower. They're not seeing inflation come down, and that is the reason why the CPI report was a real pivot for the market and not in the right direction if you want to be long risk assets.
It wasn't like the end of 2018. Or for that matter, during the pandemic, where you could actually identify things that felt disorderly,
right?
Particularly in the pandemic. And late in 2018, you had the whole primary market totally freeze up. Right. In the high yield market. We're talking about a justified change in price right now, not disorderly price action, at least not yet in the major parts of the market.
Justified by what's going on with inflation, but interesting that you note the credit markets. The fact that we haven't seen disruption there raises this bar even higher for the Fed to intervene or the Fed to take a pause, because you are still able to raise money, even if it is at a higher cost.
We joked a few times over the last week as to whether Chairman Powell just needs to reread the Jackson Hole speech, Tom, in the news conference next week. Do you think the market's finally getting the message after flirting with maybe a pivot just 2 weeks after it for a moment in time?
Why would he not read that speech? Because of the international tea leaves that are out there. I take your point completely. Domestically, the stock market, full faith and credit, the spread world that Lisa follows, international has shifted this week.
Do you think it's starting to bite, Tom, in a way that feeds back into the Fed story
it will affect
that makes them
his
take
dialogue.
attention?
They're going to say forever they're not focused on it. Absolute baloney. Philippine peso pushing through 58.60 would be a crisis for that nation, just as one example. And there's 15 Philippines out there right now, including Colombia.
Okay. At the same time, they want to get inflation lower. A strong dollar helps them achieve that. So what's the incentive domestically for them to do that? I mean, they're not central banker to the world, even if the rest of the world views them that way.
It's everyone else's problem, at least for now, and it's not the Fed's problem yet. It may well become their problem soon. I think the Bank of England, just around the corner from here, is a perfect example of a bank that's got to grapple with this.
Exactly.
Sterling at 113. Guy said it earlier. Importing inflation. It's problematic.
I saw Governor Bailey coming out of Greg's.
What did he say?
He was too busy chewing on his sausage.
How many sausage rolls have you had?
I've had a few.
Where was he supposed to go when he stomped out of the other restaurant?
He recognized me, turned around and walked away.
If you are just tuning in, Tom did storm out of breakfast this morning, and as is my day job, it was my role to try and, smooth things out with the hotel. Futures.
They are feeling their way to how far they have to raise the federal funds rate. They want to be restrictive. They want aggregate demand to slow down a lot so that that underlying inflationary pressure starts to ebb. But what they don't want to do is intentionally cause a recession. And getting to that point, I think, will require a bit of luck.
That was Morgan Stanley's Seth Carpenter on with us just moments ago. Bloomberg's Ira Jersey joins us right now from Princeton for more on this bond market. Ira, through 390 on a 2-year. As you reset and consider where this is going next, what are you thinking?
Yeah, it keeps going higher, and I think that as we start to reprice the Fed for some potential of a terminal rate that's above 4.5%, I think that 2-year notes at this point can keep going. I mean, we thought that we would be somewhere near here at the end of this year, so we've just gotten to these all of these levels much faster than we thought, and I think part of that is just the persistence of inflation and the insistence that the Federal Reserve has that they're going to keep on fighting inflation for now.
3 months ago, Ira, that would have been a revolutionary call, 4.5% of a Fed funds rate. But that is currently what's being priced into the market. How long can the Federal Reserve hold interest rates at that type of level, let alone even get there, before you do get some sort of big deterioration or market event?
Well, thanks. That actually was our call back in June, so I appreciate the fact that you said that was revolutionary. Back then. Our call has been that we would reach there in January or March of next year, and then I think at that point the Fed holds there for at least 6 months. Now, 6 months is not atypical, right? So if the Fed gets to the terminal rate, usually there's about a 6-month lag before they start to cut interest rates, but so much of that will depend on the path of inflation over that period of time, right? If inflation comes down much faster than we think, and core inflation measures in particular start to come down, unemployment rate starts to go up, those are the things that might cause the Federal Reserve to follow the market's current path and start to cut in the second half of 2023. But if it doesn't, if the economy holds up a little bit and that kind of the swoon that's going on now is more of a mid-cycle correction, which is what I think it is, then the Fed can hold there maybe for 9 to 12 months before it starts to cut interest rates.
I'm not asking this in a snide way. Are people losing money now? Is it like ugly in bond world now with price down, or is it being managed?
Well, a little bit of both. I think one of the reasons why you've seen some of these large moves is people are getting short, right? You look at futures positioning, and just about everyone who can be short is short. Now, obviously in futures you have to have an equal number of buyers and sellers. But if you look at the repo market and what's gone on in some of the funding markets, where you need to just from a structural perspective, that's where all the hedging goes on. It seems like a lot of people are short, and that's one of the reasons why I think you've seen these major pullbacks when you get somewhat better data from an inflationary perspective. You just see the market bouncing around so much, because it is hard to be short the market, because the problem is being short right now means that you're paying 3+%, almost 4% if you're short a 2-year note, because if you're short a bond you have to pay the coupon. So it's just hard to be short for a long period of time.
Ira, thank you. It's good to catch up. And what a call that was, by the way, on the 2-year earlier this year, because hardly anyone was calling that. Right. Greg Staples is joining us now, the head of North America Fixed Income at DWS. Greg, I asked this to you a few weeks ago, so let's do it again. Have we seen the highs of the year on these yields yet?
We haven't seen the highs, I think, in the 10-year Treasury. I don't think we've seen the lows in the euro. I think we're going to go through 3.5% fairly soon. There's a lot of buying that's waiting to get to 3.5% 10-year, so we could bounce around a little bit here, but I think looking what's going on the 2-year, it's going to pull longer rates up eventually as well.
What's the high for the 2-year? When do you start to get confident that perhaps we've gotten full hawkishness priced in?
There's a bit of an upward gravity pull, if you will, in terms of the expectation of the terminal Fed funds rate, and obviously we've seen that repriced just over the past week or two. 4.5% seems to be the number right now. As you know, Matt Lozzetti, a colleague of mine, is talking about potentially 5%, and as long as that number is going up, it's going to pull the 2-year up with it. 4% is certainly not beyond the pale, and perhaps even as much as 4.25% before we finish this cycle.
How does credit respond to this, Greg? Does issuance go on hold?
We've seen a fair amount of issuance already. I'll tell you, I think there may be some acceleration from market participants to try and issue within the marketplace. It's a concern that if they wait a little bit longer, they face both higher coupons, higher funding rates, and the possibility that the window shuts overall. I know one thing that we've been talking about on this program and elsewhere is our concern about evaporating liquidity overall in the marketplace. It's a function of, we were talking about earlier, the idea that regulatory capital is making the funding markets dry up a little bit, as well as the pernicious effect of QT. I mean, nobody quite knows when this now $95 billion a month runoff from the Fed's balance sheet actually starts to impact liquidity, but we're starting to see it already in terms of the ability to find bids within the marketplace. Bid-offer spreads are widening in the Treasury market. It's not too concerning yet, but you don't want to wait until you need to find funding and then find out that it's not there.
What's the easiest way to measure liquidity in the market for mere mortals?
From our perspective as real money fixed income investors, it's our ability to find bids within the marketplace for the not go-go bonds. We're talking about the bottom half of the S&P 500, if you will, the triple Bs, those issuances of maybe a $500 million outstanding, and you go to market and expect to get a decent bid from 2 or 3 dealers, and you're finding your marks a point or two below what you had it marked at just because the dealers don't want to step up. Again, we're not quite there yet, but it's starting to get a little bit concerning.
Greg, can we just pick up on a theme that Lisa's been pushing, including in this conversation as well on QT? Where is it? Where's the balance sheet reduction, Greg?
You know, it's tough to say. We're looking at the mortgage market in particular, where the Fed has indicated that they don't really want to hold mortgages overall in their portfolio long term. They'd like to run that off. There's a lot of concern within the mortgage market if they accelerate that runoff by selling lower coupon mortgages. The Fed owns a material part of the 2 and 2.5% coupon mortgages that were issued over the past 2 years, and those aren't disappearing anytime fast because prepayments are so slow. So do they start accelerating outright sales with that and disrupt that market overall? I think they're concerned about raising mortgage rates much higher than they are right now. And broadly, QT, it's a ways away before it truly impacts. I think banks are happy to see their balance sheets reduced right now. It eases some of the pressures from the SLR, the supplementary leverage ratio, so it's probably going to come out of Fed repo. But ultimately, I think it just means a lower level of liquidity overall in the marketplace. It's the reverse of what they did for 2 years when they were pushing money into the marketplace through quantitative easing.
Hey, Greg, thank you. Greg Staples there of DWS. 5 minutes away from the opening bout with equity futures lower, yields higher on a 2-year through 390, on a 30-year up 6 basis points at 352. And equities down by what, 1.3%? Down by 1.4%? That's where we are, Tom.
John, I'm focused. I mean, I'm looking at the train. I've never gone as far out as zone 3. Like if I take the train from London Bridge out to Tottenham,
you're getting on the
like
underground. Where are you going?
There's a game, or there's like they're playing Lister. The Tots are playing Lister.
Okay.
I guess.
Cool. When's that happening?
This weekend, I think. Are they going to have matches?
Oh, you're going to a game. Nice.
I'm considering it.
The opening bout, just around the corner.
Yeah.
Seconds away from the opening bell in New York City. The opening bell just about to ring with futures lower by 1.15% on the S&P. On the Nasdaq 100, we're down by 1.16. On the Russell, we're down by 1.2%. Call it negative 1.1. In the bond market, yields a whole lot higher through most of this morning on a 10-year, on a 2-year, on a 2-year through 390, on a 10-year approaching 350, up a couple of basis points to 347. Dollar a whole lot stronger against pound sterling. Earlier 113 on cable. Right now on euro dollar 99.67 on that currency pair, negative 0.33%. With some moves around the opening bell, let's get to Abby for more. Hey, Abby.
Hey, John. Well, this sort of sell-off that we're seeing for futures, that's what happens when you have FedEx having its worst day since November of 1980. Back then, the stock dropped 47%, but right now down 22%, of course, on that bearish pre-announcement, also pulling the guidance, volumes declining on macroeconomic worsening. Asia, Europe, areas of weakness there. This, of course, is reaffirming the idea that a global recession, a global slowdown is here or very soon. And it's confirmed by the idea that GE, they also recently pre-announced to the downside for their third quarter at least. Now they're talking about the supply chain, but to have another conglomerate or to have that conglomerate also pre-announcing, plus McDonald's, Alcoa. And it's also worth noting GE, their big business is aviation. So if FedEx is seeing such weakness, it could pull on GE's business going forward. Now, these pre-announcements also weighing on UPS and Amazon, that e-com giant falling as well. And just worth noting, John, of course, that you've had lots of big names recently joining Mike Wilson over at Morgan Stanley in terms of the bearish call, the likelihood that the S&P 500 drops 20% from here, including Ray Dalio and Jeffrey Gundlach. Goldman also talking about bearishness. It seems to be here, the confirmation from the global economy, these signs that we really are seeing this slowing.
Abby, thank you. That drop on FedEx down 22%. Lisa, the biggest one-day drop potentially going back to what, 1980?
Yeah, and the $11 billion of market cap, just to put it into perspective at a time when a lot of people are wondering who's next.
FedEx down and down hard. Sticking with big tech, I want to turn to them right now. Equities down, yields up, tech getting hammered. Ed Ludlow joins us now from New York for more. Hey, Ed.
Yeah, good morning, John. Down 1.5% on the Nasdaq 100, coinciding with that stronger dollar, but also the push higher in yields. This chart actually showing the relationship between the Nasdaq 100 and real yields, but but of course, you and I both tracking the movement on the 2-year and the policy-sensitive end of the curve. There seemed to be a real relationship there with tech throughout the week. What I find interesting is the breadth of the sell-off in tech shares. It's not just the speculative corners of the market, but the mega caps as well. You look at names like Microsoft and Google, often considered defensive holdings, right, because of the strength of their balance sheets, their entrenched competitive positions. Year to date, though, we're down collectively $3.2 trillion worth of market cap. You also think about the likes of Amazon, of course, impacted by the news overnight with FedEx because they are suffering the same cost pressures, but now there's the concern about the suffering consumer. And with that inflation print we got earlier in the week, we're moving past the inflation discussion towards the narrative for higher rates, not just because they discount the present value of future profits, but what does it mean for households, right? And the accumulation of debt, because iPhones are expensive these days, John, and it's interesting to continue every day seeing these mega caps decline with the rest of the technology sector.
I think, John, what's so important here is you look at the tech analysis and it's about growth of revenue. Is it going to be the only place with actual revenue growth on a relative basis? How does everybody else do from tech?
As it was in the pandemic.
Yeah.
But very, very different situation
Different
compared to
now,
where we
but
are.
I would really watch off tech.
Equity's getting hurt here. We're down by 1.3% on the Nasdaq 100. James Athey joins us, investment director at Aberdeen. James, let's start here with something Michael Harnett over at Bank of America. What he said this morning. He said that yields make new highs. That means stocks have to make new lows. Do you agree?
On the yields front, I mean, I've been a little bit wrong. I thought once we'd had that blow off top to 350 in 10-year, we probably had seen the highs for the year, and we're perilously close to making new highs, right this second. So it feels a braver call to say, yeah, we're absolutely done. We are leaning against this level because we do think that the tightness of monetary policy that's coming down the pipe really is going to hit economies like a sledgehammer, and that should just continue to invert the curve. So we're happy to lean in, but I certainly agree with the idea that higher yields reflecting tighter monetary policy at a time where consumers are battling with negative real income growth should be a cold shower for the equity market, and it is a cold shower for the equity market. With respect to big tech, just quickly, a good company at a bad
Sure.
price is a bad investment. I think that we're seeing some of that coming out now.
Someone at Goldman might be getting a cold shower right now. Sri Natarajan has the story. Hey, Sri, walk us through it.
Well, we've all been talking about the Goldman consumer unit expansion and how it has grown over the last few years, but this 6-year-old venture is now facing scrutiny from the Federal Reserve. Our sources tell us that officials at the Fed have been conducting a review of the business over the last few weeks, and it is very much ongoing. There is no indication of any wrongdoing, but it certainly goes beyond their regular business of oversight and is also distinct from what they sometimes do, which is industry-wide dive into various business areas of interest. This is a very specific look at Goldman and its consumer unit, and it adds another headache for their CEO, David Solomon.
Sri, what is the difference between an SEC review and a Federal Reserve review?
To be very clear, from what we understand right now, this is part of their regular oversight. Fed oversees Goldman Sachs. They're always in conversations with them. But this goes beyond that, where they are drilling into this business and making sure that the business and its managers and leaders have complete control over what is going on. Since the business is still losing money, it was supposed to break even this year. That has pushed out. It has lost more than $4 billion since inception. This year, they're set for record losses, and that could perhaps explain some of the heightened interest from the Fed in this case.
So just elaborate a little bit more, the heightened interest in terms of stability or heightened interest in terms of something else having to do with this unit?
I think it's fair to say when you have a firm like Goldman that really has no real history with the consumer market, it is a storied Wall Street firm. It has dealt in the world of high finance with hedge funds and corporations and governments, but never really with consumer. It has grown rapidly in that space. By 2024, it hopes to have $4 billion in revenue. That is pretty incredible growth. At the same time, I think regulators would want to make sure that they're doing it in the right fashion and in the right manner. And the fact that they've already missed their own targets in terms of breaking even and profitability, that is something that would pique the curiosity of regulators.
Sri, how much support does the leadership at this bank have from shareholders?
One way to look at it, this year the stock's down about 13%, middle of the pack. Since CEO David Solomon took over on October 1, 2018, the stock's not really done much to close the gap between, say, the likes of JP Morgan and Morgan Stanley. Price to book, it is still exactly where it was 4 years ago. That's not a good picture, especially when you have a competitor and arch rival like Morgan Stanley doing much better. At the same time, in a year when you're expecting earnings to fall roughly 40% from the boom times of last year, you will have other parts of the division and other senior leaders at the firm irritated that there is another large unit that is soaking up cash, which is likely going to lead to less compensation for a lot of folks and even layoffs down the road in the next few months at Goldman Sachs. That's going to lead to increased grumbling.
Hey, Sri, thank you. Great work by you. Fantastic reporting. Sri Natarajan there of Bloomberg. The stock, Lisa, on Goldman, we're down about 3%.
Yeah, and this comes in tandem of both this story that Sri Natarajan reported for Bloomberg, but also just this concern about banks and what the future holds at a time when the yield curve is inverting and consumers are spending less and fewer deals.
James Athey's still with us, investment director at Aberdeen. James, banks have finally got what they wanted, higher rates, and seemingly it's still not helping banks, and that's true of Europe and it's true of Wall Street as well. What are your thoughts on that sector now after Citi earlier this morning went underweight the financials?
Yeah, I mean, high rates in and of themselves, I guess, really don't solve the problem, right? I mean, just at a very basic level, banks are in the business of maturity transformation, so they borrow short and lend long. So the gap between short and long rates should be directly, related to their profitability. So an incredibly flat yield curve means that they're having to borrow money at quite high rates and not able to lend it at much higher rates, or even lend it at rates which are lower. So that it's not surprising to me that higher rates but a flatter curve has not been a fantastic period for banks. But realistically, these are incredibly complicated institutions that are now regulated in an incredibly complex fashion. And you've just mentioned it there in terms of reporting the delta versus last year. The bar was particularly high for a lot of sort of corporate activity last year. So headwinds in markets, headwinds in banking, and headwinds in sort of advisory and IB. It's not too surprising to me that they're pretty unloved at the minute.
The story that Bloomberg reported about Goldman Sachs had to do with the consumer-facing unit, and I'm not going to get into the investigation aspect of this. I'll wait for more details to come out. But, James, there is a question about the health of the consumer and whether that's adequately been priced into some of the consumer-facing equities that we've already seen get beaten up quite significantly. Is it enough?
Short answer, no. I think, again, looking at that move in FedEx, that's not particularly normal, and that looks like a cold shower moment. Markets seem incredibly reluctant to be too forward-looking when the future doesn't look particularly rosy, and so I think it's a show me the money kind of market. And so we see when certain results don't come out in accordance with expectations, and particularly when guidance is weak or guidance is removed altogether, then you suddenly just get this abandonment of the ship and you get these massive drops. But broadly speaking, looking across the entire market, looking at some of the more cyclical sectors like discretionary consumer, they still look to be expecting earnings growth. In a lot of cases, they're even expecting margins growth, and we're still attaching really quite average PEs to a lot of these stocks as well. And it feels like all three of those are downside risks for most of the equity market.
James, with Aberdeen, you are quoted on a daily basis across all of the British financial press. I have to ask your thoughts on what this government can do for growth. Can this chancellor deliver a growth mandate for the United Kingdom?
In the very short term, Tom, I think it's a really difficult situation. I think I can understand from a slightly cynical perspective why the Prime Minister is talking about the energy policy that she is, partly because it will mechanically keep inflation capped, and that should keep the Bank of England more on the sidelines. But it's a very blanket approach, and therefore you're giving money to those that really aren't in need of it. I think something that's more distributionary would be more appropriate and would take away some of those upside inflation risks. But where we've come from over the last 4 or 5 years, including the pandemic, to where we are now, has left government finances in a far from healthy state. And in the UK in particular, the expansion in the current account deficit at a time where sterling is falling and gilt yields are rising is a really risky combination for a government to be sort of priming the fiscal pumps. Ultimately, my answer is always, in these situations, we've been relying too much on cyclical short-term demand management. We've been relying far too little on long-term productive structural investment and enhancements. And I think at some stage we're going to have to wear a lot of short-term pain in order to get ourselves into a position where we can start to look more medium-term, more long-term. Hopefully this is the government to do just that, but the next 12 months are going to be incredibly difficult just given the economics.
James Athey of Aberdeen is going to be sticking with us. Lisa, that's what everyone's grappling with. How much pain do we have to go through? I'll go back to something we've discussed on this programme multiple times today and multiple times over the last few months. What's the price we have to pay to get inflation back down? What are these central banks willing to tolerate? Now, they keep forecasting an inflation rate that comes down, an unemployment rate that climbs. The Bank of England's got a recession baked in. When you start to realise those kind of data points, what do people start to say back to them? And I'm in the politicians too.
Yeah, but it's also so much that's unknowable at a time when what happens, for example, with zero COVID, with China, what happens with oil prices, what happens with some of the supply chain disruptions. There's so many exogenous potential risks. How do you game that out?
John, these markets are original. There's a little bit of good in the equity market. The 2-year, a 392.
Something else, isn't it?
And we are now out on 210s to a 40-something. And I just can't say enough about the speed of movement here in the real yield.
13 minutes into the session, equities lower by 1.4% on the S&P. Live from London, this is Bloomberg.
I am very supportive of the idea of an oil price cap in general for Russian oil. We are working on amending the sanctions package that is required for this new proposal, and we know that we have to be fast on that one. And of course, sanctions always need unanimity.
European gas fluctuating as investors weigh the impact of EU intervention. The packages are building up. Will Kennedy joins us now for more. Will, Italy, the latest. Walk us through how big this one's going to be.
It's going to be quite big, John. The price cap that Ursula von der Leyen is discussing there is controversial, but it's interesting that she says that she wants to take part because the US is pushing this very hard, and it is potentially significant, but it's still unclear how this is going to work, and importantly, whether those people who are buying Russian crude are going to participate.
Well, I'm absolutely confused on this. In my week in London here, and in the next week as well, I'm absolutely baffled about where the United States of America fits into this. Europe just seems so lonely in this war, in this energy production. What can the United States do to help Italy, to help Brussels, or for that matter, to help the best team in the continent, Norway?
Well, I think the US has helped Europe. They're exporting record amounts of gas and oil, actually, across the Atlantic, but there are the limits of what they can do, especially on the gas side. The US is a huge gas producer, as you know, Tom, but they are limited in gas liquefaction capacity that puts that gas into tankers so it can be shipped across the Atlantic. As much as possible is going, so there's not much more they can do here. When it comes to the oil side, I think what the US is trying to do with this price cap is find a way to hurt Russia by depressing the price that they get, but while keeping oil flowing so that the global price doesn't get too high. Now, there's a lot of skepticism about how well that can work, but the intent is interesting, not to limit supply and force the price up, but to limit the financial gains to Russia from selling oil.
Will Kennedy, thank you so much. And I do wonder how much, John, we're going to end up with a Germany-like situation where nationalizing energy companies is going to start to be the conversation to try to get away from some of the punitive valuations that we've been seeing.
We spoke to Jordan Rochester about this, I think it was yesterday. Yes. My mind's a little bit blurred now. It's about when does it become real? Do you remember when Italy shut down over the weekend for the pandemic, and it was like that was the moment that it became real for the whole of Europe and perhaps for the United States as well? Is that moment in Germany? What does that look like for Europe later this winter?
Which is a question of when does it become realistic for markets? And James Athey, I wonder from your perspective, he's back with us, investment director at Aberdeen, and how much do we get a reality check going into winter about the crisis that everyone's talking about and seems to recognize, in theory, at least out there in policy land?
It's difficult, isn't it? There's a lot of moving parts. We've gone from being epidemiologists to now being meteorologists to try and invest in government bond and FX markets, and I guess to some degree equity markets. Whether we have a mild winter, a quote-unquote normal-looking winter, or a harsh winter is going to obviously have a huge impact on energy demand in general. The extent to which moral suasion is successful in sort of capping or reducing energy usage just in general will also play a part. And obviously central bank policy and what that means for borrowing rates, for mortgage rates, for consumer confidence, that's all going to play a part too. I struggle to see really a huge upside in terms of the economic outlook, but whether or not we get to some of the really nasty tail outcomes does depend. Scholz has been out today speaking and saying that, in his opinion, the gas inventories, gas storage that they've got will see them through the winter. If that proves to be correct, I'm sure that would be an upside surprise for markets.
I'm just wondering how much of this economic weakness so many people are anticipating, James, is actually priced. FedEx is getting hammered this morning. That's some indication that people weren't priced for a big slowdown in the global economy. I think that's fair to say, James. So I do wonder what other parts of the market are also not priced for a big slowdown in the global economy.
Yeah, I mean, just at some very simple metrics. The US yield curve 2s10s is inverted by somewhere between 30 and 50 basis points. Most of the other yield curves are still positive in that space. Your European yield curve, looking at Germany, you get some of the collateral shortage going on, but even in swaps, it's much steeper than the US, suggesting that the outlook is brighter for Europe relative to the US at a time where actually the amount of tightening that we're pricing is very similar between the two. I don't think that's right at all. I think that's a very rosy outlook for Europe. Going into the equity market, I mean, man alive, that place really does wait until the very last minute, and it's been dangled over the cliff before it wakes up. And we saw this in 2007 and 8, where equities were almost rallying right up until the cliff edge.
James Anthony, the direction and the magnitude of the move in fairly short-term paper, two-year U.S., two-year German, does it change policy over the weekend, into next week? Are those the kind of brutal moves that can change institutional policy?
But you know what? I mean, I think in most cases it's by design, and to a large degree, I kind of agree. Central banks have, kept policy way too easy for way too long. No surprise there. They've been doing that for 10 or more years. But this time, government policy was pushing in the same direction. We've got this massive inflation, and central banks were sleeping through that. Now they're rushing to catch up, but I think the rushing to catch up is the least worst option. I think it is the best option on the table for them. And in order to have that policy propagating through markets, but more importantly through the economy, and to slow demand, they need to see some of these reactions that we're seeing, where front-end yields really rise quite precipitously in a short space of time. Remember, there is a shock element to this, and of course markets are shocked, but from an economic perspective, it matters as much really how long we spend at these rates, because there's lots of debt that needs to be rolled over. There are lots of ways in which consumers and corporates can cope with high rates for a short period of time, but it becomes a much bigger drag on growth the longer it goes on. I don't think any of the central banks concerned are going to be looking at front ends at the moment and thinking, oh, this is a bad thing. I think they're actually going to pat themselves on the back and say, a job well done. What happens in 6 months, by the way, is a different ballgame. I think the Fed's comm strategy recently has been spot on. They're talking as if, they're Margaret Thatcher. This Fed is not for turning. But they have to say that, because otherwise the communication becomes the policy. The market eases for them today, and they never get to that position where they can ease off. So they have to talk tough today. Hey, ask me again in 6 months when unemployment is 5 and the economy is shrinking by 2% every quarter. I think it's going to look a very different landscape.
Let's talk before then, James. That's too long. Okay. James Anthony of Aberdeen. Thank you, buddy. It's good to catch up. 25 minutes in, we're down hard, off by 1.5% on the S&P 500, even lower on the Nasdaq and the Russell. The Russell had a few people talking up the small caps. The small caps don't look good today.
No, because they are going to necessarily be penalized by the same outlook that FedEx was talking about. People saying that U.S. momentum would escape some of the problems from overseas. FedEx casting a little bit of cold water on
Operation Get to Heathrow for you and I now.
Exactly.
Hey, you and me, we're going to head to Heathrow. Tom, going to leave you behind.
It's going to be something. We will have coverage of the funeral on Monday. Anna Edwards leading our coverage. I think it will be really something. Really, for me, harkens back to 1963 and JFK.
We're looking forward to your coverage, Tom, after the weekend. To all of you worldwide, thank you for being with us. Thank you for the team for putting together this wonderful studio for us this week. And thank you, London, for having us live from London with your market down 1.5%. This is Bloomberg.